Thanks.
Good morning, everyone.
Morning.
Thank you all for being here. It's good to see some of our retiree beneficiaries here. And I particularly want to mention my predecessor on the commission as a retiree member, Travis Pritchett, is here. So good to have you, Travis. So we begin by adopting the agenda. Are there any questions or additions regarding the agenda? May I have a motion to adopt it?
So moved. Second.
All in favor of adopting, say aye.
Aye.
All opposed, say no. That's adopted. Next, we need to approve the minutes of our June meeting. Are there any questions or proposed additions to those minutes? If not, may I have a motion to adopt?
So moved.
All in favor of adopting, say aye.
Aye.
All opposed, say no. It's adopted.
Mr. Chairman, I'll abstain since I wasn't here at the June meeting.
Thank you, thank you. And next comes the chair's report. My report is brief, but the topic is important. And that is that several meetings ago, we began the process of developing a more strategic approach to our asset allocation process. And I'm very enthusiastic about the progress we've made towards that goal. And of course, today's meeting includes what I hope will be extensive discussion on this topic. And I want to thank Mike and Jeff for their leadership in making this progress. Also the finance staff and Nikita for their guidance. Look forward to the day. Next comes the report of the Audit and ERM Committee. Phil Hancock.
Thank you, Mr. Chair. My fellow commissioners, each of you should have received our report and your materials for the meeting today. In the sake of brevity, present those as they're written. I'll be happy to take any questions.
Have we reached a decision about the outside auditor?
Yes, sir, Mr. Chair. We have engaged Deloitte & Touche to serve as, I guess, consulting and doing a lot of the heavy lifting in the internal audit area. And we've also engaged them for the enterprise risk management part as well.
Thank you. Any other questions for Bill? Thank you for your report.
Go to Mr. Chair.
Next, Mike, will you give us your report?
Thank you, Mr. Chairman, and before I get started, two things that I would like to do. We do have a new member of the staff that I would like to introduce, Ms. Consuela Swain. Consuela has joined us as our new IT service technician. She comes from us from the Commission for the Blind, an agency that's near and dear to my heart, where she worked there basically doing their help desk for 3 years. She is from Columbia, and we're so excited to have her and look forward to having her as part of the team. And I know that she's going to bring a lot to her new role. So welcome, Consuela. Secondly, I would be remiss if I didn't wish Mitchell Goldsmith happy birthday today.
Happy birthday.
Yeah, unfortunately, he has to spend the majority of his day with us rather than celebrating. But happy birthday all the same, and well, you can leave at 4:30 today. So, take all the time you need. But happy birthday, Mitchell. Mitchell obviously is a valued member of the team and has done a tremendous job helping us get to the point where we are with Deloitte and developing the development of the new audit plan and that engagement with Deloitte. So I think it's good to recognize him for both his birthday and for those efforts. So thank you, Mitchell. Next, Mr. Chairman, it is that time of the year where I have to, or I, on behalf of the agency, have to submit our annual budget request. Thankfully, it comes right in the nick of time because it's due tomorrow to the governor's office. So just kind of highlights for this fiscal year, in the past several fiscal years, I think 3 of the last 4, we've been a very unique agency in the fact that we've asked for less authorization, which does usually make the committee hearings pretty uneventful. They don't tend to ask a lot of questions if you're asking for less money, other than the initial shock, because most agencies are asking for more. But we have asked for less authorization over the past couple of years, but I think that it's time for us to pause in that. I think we're at a good authorization level right now. We do have some room in the budget to grow. We will be bringing on some more staff over the next few years. So I think that it's a good time for us to pause and to hold things steady. And the other thing for us to keep in mind too is when we've asked for less authorization, none of that decrease in authorization amount has been in personal services. It's all been related to savings that we've been able to achieve in our other operating expenses, where we have outsourced various systems and have moved several of those more expensive relationships and systems to our custodial agreement. But that being said, my recommendation is that we hold steady this year at the authorization amount that we're at. And this is just a overview of our organizational chart. I can certainly answer any questions about that, but that's always available for anyone anytime that they would like to see it. And then we look at our appropriations history since 2016. 2016 was a high watermark for our authorization when we were at about 17.8 million. As you can see, we've worked that down pretty substantially now to where we're asking for 15.3. Again, all of those reductions have come in the other operating expenses and not in our personal services. In fiscal year 19, we did have some additional expenditures relative to fiscal year 18. We had a few more FTEs that we brought on that we utilized during that fiscal year. We've taken on some additional services that are provided by Alborn, so there's been some expenses related. There were some expenses related to that, and we had basically we're finished paying for the fiduciary audit from Funston, which was completed in November of 2018. Currently, we are $15.3 million total budget. Just a reminder for everyone, and this is something that we remind people across the street, we are all other funds. We are authorized to expend these funds. None of the general fund money comes from, there's no general fund money that's used to fund our operations. It's all an authorization to expend trust funds. We also try to be very mindful of how we spend and how we pull down money from the bank in order to operate. We draw quarterly, but we only draw, in essence, what we need, and if there's anything left over, that's just less that we have to draw the next year. That 15.3, because obviously we want to keep money in the trust, we want it to be able to keep it there, earning a return rather than sitting in our accounts here at the state level. The breakdown of that 15.3 is 7.2 in personal services, 2 million in employer contributions is where we've seen probably the most significant increase in need over the past several years, and that's basically benefits, so retirement contributions, health insurance premiums, those types of things. And then 6.1 in other operating expenses. We do anticipate that there'll be additional expenditures for FY20 versus FY19. We're finishing building out our Microsoft Dynamics system. We have the Deloitte engagement that we are paying for, and for the audit plan development and year one execution. We have brought on, I said, we've engaged Alborn for some additional services around consulting on hedge funds. We do anticipate that we'll fill some of the open FTEs that we have, some if not all of the open FTEs that we have. But that is countered by savings and other operating expenses. So we think that we will still be, that will net out, that those expenses will net out, although we don't need additional authorization.
Mike, what is the Microsoft Dynamics system?
You wanna, I'm gonna pass that right off.
I don't blame you.
Bill, it's some type of sorcery that it has to do.
Basically it's a case management system, but it's customizable. And so we're looking to leverage Microsoft Dynamics and customize it to do investment lifecycle management. So it'd be an automated system with notifications that would be across the business operations.
So when we're
This is
looking at prospective manager, we would put it in there. As it moves along the pipeline, people would be notified, the investment team, ops due diligence, compliance, when actions are required. And then would also be used to help us store due diligence material. So,
Okay, thank you.
Like I said, sorcery. So the, so our FY '21 budget request remains the same, as our FY '20 request. Again, we're not requesting any more authorization. We're not requesting any more FTEs. We plan to hold steady with the amount of FTEs that we have currently. You can see our FTE request history. We're at 51 authorized basically and approved for the since FY '16. And the vacancies that we have right now, we have open positions in our junior analyst program, which we will ultimately look to fill towards the end of the school year, because most of those we have one new junior analyst coming on at the end of the calendar year. We will look to add more to that program at the end of the school year. But that's a program that's constantly cycling through. People are constantly moving through the program. So whenever we have a need, that's the first place that we go to pull people, to graduate folks out of the program and use them, put them in permanent positions. We'll be looking for a private debt officer, one private equity officer. We're looking to add another officer to James Wingo's quantitative solutions group, and an additional real assets officer.
So Mike, how many people will that in total when you fill out all the full-time employees?
That would get us to the full complement of 51.
51?
51 full-time. And one of the things that we did is we did a leadership retreat last month, and one of the things and we'll be bringing a business plan for the commission to review in November. But we spent a lot of time projecting out, both personnel needs, where we think where we're going to need additional personnel, and making sure that we have the resources allocated correctly. How we're looking for it as far as systems go, and we feel like that we're in a good position. And once we get here, that at least for the foreseeable future, I think that we'll be fully staffed and have the capabilities in the places that we need to manage the organization.
Mike, one of the risks that Deloitte brought up in their risk assessment recently was difficulty in Columbia, South Carolina, difficulty in hiring investment staff.
Right.
Is that restricting us on any of those positions?
I think, the junior analyst position, I think actually ironically being located in Columbia, I think is much more of a benefit, because if you think about the business school being a ready source of talent for us, it's great that we can see the business school from our office. And it also makes it very convenient because if you think about intern, analyst, permanent, that it's easy for us to get young people from the university to come intern. That's a big pool as a ready source of talent. So I think in that way it's a strength. with regard to, you know, kind of maintaining, personnel and recruiting and retaining talent from, you know, retaining the talent that we have within the organization, recruiting talent from, so if you think about buy versus build, from outside of the organization. One of the things that we're doing is this year, we'll do another round of, it's time for us to do a compensation consultant, to hire a compensation consultant to review our compensation policy, review our levels of compensation to see kind of how we stack up. We've also tried to get very inventive when it comes to quality of life type things that we think are make RSIC a great place to work. So we've been rolling out several of those initiatives over the past couple of months. You know, I think we're doing the things that we can and the things that are necessary to recruit and retain good talent. And you know, I think we're very good about providing a very robust education and training opportunities for our staff. Because my adage is that we train people to do the next job, whether it's here or not. You know, because at the end of the day, I want to see folks do well, and hopefully that's here at RSIC. But if it's not, then if they find a better opportunity, then we should be supportive of that. I personally feel like that's a little bit of I see it a little bit differently than Deloitte. I think like that's probably it's definitely a risk, and it's an elevated risk. I don't know if it's quite. I wouldn't know if I would necessarily grade it as red, but you know, that's not my lane. So, but I think we're doing the right things to make this a place where people want to come and learn and grow and hopefully stay, because we provide them with a mission. You know, I mean, we're always mindful of we're here to support the beneficiaries. So, you know, hopefully that rings true. That rings true with the people that I think that we want to stay.
And I would just add, I've talked with Jeff about this a little bit, but I do think it's underappreciated kind of what's going on the ground, both in a Greenville or a Charleston, right? I mean, we've never had satellite offices of this agency, but a lot of other agencies certainly do have field offices and other offices. I mean, I think there are other ways to solve for that and be competitive. You'd be shocked what the Monday flight out of Charleston looks like.
Yeah. You know, and we've also kind of, you know, we don't just recruit people from USC. You know, we've expanded our reach into developing relationships with other colleges and universities. And we're, you know, we're in the process of attempting to develop for instance, a partnership with Converse. You know, because the other thing that we're trying to do too is we're trying to increase the level of diversity in the organization, you know, from both a minority and both minority and gender diversity. So trying to not just look, even though it's very convenient that the business schools right down the street, that's not the only source of talent that we see. So, right.
Other questions for Mike?
There's a motion with regards to the budget.
Mike, will you read the
Yes.
motion?
Yes, sir. Mr. Chairman, the motion would be the commission authorizes the CEO to submit a proposed FY 2021 detailed budget substantially similar to the draft budget presented for inclusion in the governor's annual budget.
Didn't this come from committee, so it doesn't need a second, right?
No, this is coming from me, so.
Oh, from you.
Yeah, yes.
Any further discussion? All in favor of the motion, say aye.
Aye.
All opposed, say no. Motion's approved. Next, I ask Jeff to give the report of the CIO.
Thank you, Mr. Chairman. Well, before I get going, in a moment, David King's going to walk us through our traditional performance presentation. I wanted to give some high-level perspective from my perspective on our performance this year, as well as to have a short conversation about the environment, the market environment, the economic environment as well. At a high level, our performance has continued to improve Main reason for this improvement is unsurprisingly the fact that our policy target includes more public equity than it did several years ago. I also want to point out that we've asked a lot during the last 3 years of our staff. We've asked people to do a lot of different things that we as an organization were not accustomed to, challenging beliefs. We've asked our private markets folks to embrace a different way, a more quantitative way of assessing managers in service of trying to improve our private markets returns. We created a team, and James Wingo's done a phenomenal job in this regard, created a team and asked it to try to integrate into the way we think about asset allocation the key risks as we understand them of the entire system. And I think we've done tremendous work in that regard. And most recently, of course, we've been challenging ourselves to think about ways that we can improve reporting to align it with decision-making more clearly, but specifically so that I and you all can have a more valuable perspective on performance. In the Makita performance report that's included in the deck, they include a net of fees performance universe. For the year, our ranking in that universe is 51st percentile. I don't want to go long on or pretend that I have great love for those styles of rankings, but I think the thing that I do take as valuable about this is just that we have done what we set out to do 3 years ago, and we have returned to the pack. So we are not having extreme differential performance without any clear kind of thesis as to why we look different. We've challenged those beliefs, and we've decided, equity is a productive long-term asset. We are a long-term investor, and that makes that an attractive way of driving return for us.
Jeff, before you leave that, if I could,
Please.
one of the things that I think too is, and Jeff and I'll speak probably about this later, but one of the things that I think Jeff and the investment team should also be congratulated on is that we've seen that increase in, the I-2, there's, we can argue about whether or not peer comparisons are a good thing because they're ambiguous and they're not investable and they don't necessarily meet the, meet what you would consider to be an optimal benchmark. But I think our improvement in relative performance, whether you're in a gross of fees universe or a net of fees universe, regardless, we've seen significant uptick in that relative performance. It gives me comfort that we've added additional risk to the plan, undoubtedly, in order to get to where we are, but that we're seeing improved return as a result of adding that additional risk. The other thing that I think that the team should be congratulated on is we're also managing it. We're managing the plan at a substantial savings compared to where we were in, say, 2013, which was the high watermark for fees as a percentage of AUM. So if you apply just the management fee, not the carry or the other expenses, just the percentage of AUM of the management fee in 2013 to our AUM now, we would have paid $50 million more in fees last year. So $50 million we've taken from a percentage of AUM out of the structural cost of the portfolio. We are actually on just a raw dollar amount. From a management fee perspective, again, just the management fee portion, we are managing $4.5 billion more in AUM for less money, in raw dollars as well. Now, the carry goes up and down, and, there's some of that you want to pay because that means that you're doing well, but all completely across the board, we are managing the plan at substantial savings. And not only have we taken that structural cost over the past few years out of the portfolio, But the other efforts that we have ongoing, like the BDC, the JV, the BDC JVs, the co-investment program, and other initiatives that we have where where we're able to invest at low or no cost. We project that those will take another $66 million of fees out of the portfolio on an annual basis. And the great thing about those efforts is that it really fits within kind of our reason why we look for fee savings, because we look to reduce fees to the benefit of the portfolio, and that most if not all of those fee savings will be accretive to the overall return. So you think about, add that together, that's over $100 million in less cost that we would be paying otherwise, but on an annual basis, once these programs get fully ramped, that we would otherwise be paying if we had not really had a concentrated effort to reduce management fees. So I think, the increase in performance, so we have improved returns and we're managing more for less money. So I think what our first core value is humility, so we don't want to do a victory lap and hang the mission accomplished banner. But I think there's a time and place where you can at least, take a moment and celebrate what you've done. And I think that, we have significantly improved the performance of the plan, and we're doing it at less cost. So, and the credit for that goes to Jeff and the investment team and really every other member of the organization, because it's a group effort. So, I'll get off my soapbox. So,
Thank you.
yeah.
So I'd like to hit on some of the things that have worked out well and some things that during the year didn't work as well. Our overweight to public equity from December to June certainly was a positive contributor to the returns. I love, Mike, you just used the phrase mission accomplished banner, because in my notes to myself, the second point, it's too early for us to order the mission accomplished banner, but the early signs from our recent private market investments are very good, and I'm enthusiastic about the work being done there. Third, as we added public equity risk to the plan, we've been under the hood in some other areas, been reducing risk, most notably in private debt and real estate, where we've gone to more conservative kind of baseline approach of direct lending and private debt and core real estate strategies. And we've done it, and even those have worked well. Early signs are that we're getting very strong returns from those decisions as well. Thing I want to make sure that I single out is our real estate portfolio continuing to perform very well. Eric Ravelli, who's I don't think is in the room, but we'll get word to him, has done a great job with this portfolio, and we continue to outperform here, even as I just mentioned, we've been taking down risk in this portfolio and focusing on core strategies as opposed to some of the higher octane things that we started out with. So on a personal level, my hat's off to Eric for what he's done there. And some things that haven't worked as well during the year. In order to fund our overweight to public equity, of course, we were underweight fixed income. These strategies performed well as the rates market started behaving very differently than we expected. The bottom falling out of rates caused these strategies to perform very well as well. So this strong performance in what we were underweight sort of eats at the outperformance from being overweight equities, but still net, it was a very positive outcome for us. We have some legacy private equity and private debt investments that have continued to perform poorly, and this has been holding us back a bit. I do want you to know that we are on it, and we're working through these challenges and creating liquidity where we can. I'm not inclined to speak about anything in particular in open session, on that front. Our portable alpha program, this is usually a topic when we're talking asset allocation, and I do want to flag it's something that we believe very strongly in, particularly in a low interest rate environment. But this year it didn't perform in a way that added value. At the total plan level, it hurt our return by roughly 7.5, 8 basis points for the year. It's not terribly significant, but it is something that I think should be on the radar and something that we should make note of periodically. Active management was a challenge in a lot of parts of our portfolio during the year, largely a first half phenomenon. Active management worked very well in the second half, but it was just such a challenging first half of the year that even a strong second half was unable to make up for it. And finally, our equity options portfolio has been a bit disappointing, not in terms of the quality of our implementation, but just as a beta in the portfolio. As a reminder, we think of this as an asset class that performs like equity over time, not all the time, but over time. And it has lower volatility than regular traditional equity. But the last few years this hasn't been playing out, according to that refrain. So we've had slightly lower returns. The volatility aspect of it has been in line with expectations, but just the returns haven't been because the volatility level in the market until recently has been rather suppressed. But I did want to make note of that. Shifting gears to the market environment, I think the story of the year is, or a couple stories of the year, declining growth and inflation forecasts worldwide have reached our shores. In the U.S., the decline in inflation has actually exceeded the decline in growth forecast, which has wound up in an interesting way being a support to both equities and bonds, bond prices. Weakness is due, this usually comes up in any discussion, but it is due in part to the inability of global markets to understand and foresee an end to the trade war. So against the backdrop of slowing growth, asset prices can begin to appear elevated. Treasury yields are probably the greatest example of this, or treasuries are the greatest example of this. Yields down exceedingly sharply from a year ago. Frank, or Peter is actually going to walk us through Makita's take on this, so I won't dwell here, but Alan and I were talking last week, and when we talked, there was 17 trillion of negative yielding global bonds. I guess I should be thrilled to report this is now only 15 trillion of negative yielding global bonds. And this highlights us a supply problem. There's just not enough high quality yield in the world, yield product, and this can drive investors into other asset classes in order to look for return, which leads to elevated valuations for equities versus historical levels. Non-U.S. equities, temptation is to find them cheap versus domestic equity, but you have to remember that these are different parts of the world where the growth picture is less clear. Leverage levels appear elevated in the equity market, not only public, but we also see this very clearly in private equity as well. I think it's important to also realize that the equity market and the bond market have had sort of mixed signals here recently. Treasuries could be telling us, both because of the level of yields, but also the slope of the curve, that there are serious concerns for growth and inflation, while at the same time, the equity market is trading very near its recent highs. Again, our friends from Akita are gonna talk about the challenges of the lower interest rate environment in a bit. But the bottom line for our portfolio that I want to convey clearly is this is a challenging environment, and the way that we are responding to this challenge is by being overweight liquidity right now. So that we have flexibility to react on an as-needed basis if opportunities present themselves or if threats present themselves. So I'm happy to field any questions, but if there aren't any, I will yield the floor to Mr. King.
Jeff,
Yes, sir.
this is kind of going ahead a little bit, but all this talk in the last few days of pressure on the Fed to lower rates even further and to even go into negative territory. What would be the implications for our portfolio under those circumstances?
If there is I think there's you need to, give you a stab at this in a second. If you have to have not only a view about the inflation picture that underpins that rates decision, but is there a corresponding challenge to growth that we're trying to stimulate? I think it would be almost like a carbohydrate high for markets with not a lot of protein behind it. So I think it would be near-term positive, long-term more challenging. I think as we sit here with a 7.25% target return, unquestionably it makes that exceedingly difficult. So if you're asking the question from how does our portfolio respond versus how does this create strain on the system more broadly, I think you get a little short-term benefit from the discount rates for all risky assets declining, but then you're in a much more challenging environment for us as a pension system. I think it becomes a very serious challenge. You want to add?
You just said what I was going to say, but Mr. Hancock said to me just before the meeting started, it's very hard to hit 7.25 if interest rates are negative.
That does sort of make it simple. Math.
Well, I mean, we've seen what's happened here with 16 trillion of negative debt in the world, and yet it has done very, very little to stimulate growth.
Yep. And that's the question here is, what is the marginal benefit of a rate cut? And that, I think, is the question that is vexing to a lot of people. The mid-cycle cut was kind of pitched as a single, but if you look at the yield curve is suggesting that more is to come, or growth is going to come back, I would argue. I looked this morning at the yield curve, and the 1 month, the 1 month treasury is the high point on the curve until you get beyond 10 years. Classically, that is a bad signal, which is part of why we're being as cautious as we can be with rates.
It seems to me that the greater risk at the moment is less economic than it is geopolitical, because we simply don't have much visibility on what some politician is going to come out with tomorrow, next week, or next month. That's very hard to predict.
Oh, it's challenging in our seat. but I read a lot about this, and it can be challenging for, if you're a corporation and you're trying to figure out how do I establish my supply chain for the next 4 or 5 years. You know, you would like to have some visibility into resolution of the trade war in order to be able to engage in a capital project and begin to figure out, is my next factory in the US? Or is my next factory in Mexico or China? Or, you know, these are the types of decisions I think that have to be on hold to some extent these days in boardrooms. So.
For the last, I'd argue, 3 years, there have been two factors that have been driving the markets. One is central bank policy, and the other is, you know, geopolitical factors, and more specifically the policies of President Trump. And the one is actually a fair bit easier to predict than the other. The central banks, they've been pretty good at telegraphing what they're going to do. But as you know, you've seen, especially in the last 12 months, the swings in the equity market, you know, being up 5, being up 10, being down 10, have coincided almost perfectly with, you know, trade wars on, trade wars off, trade wars on, trade wars off. And the markets don't like uncertainty. And the more they see this volatility, that, you know, now it's, you know, not just the market, it's, as Jeff was explaining, flooding through to actual corporate America. You know, we've seen, from a manufacturing perspective, you probably saw the PMI is now at a point where you could say, all right, we're in a manufacturing recession. You know, they don't know what to do. They don't know, again, where the supply chain is going to be. Is it going to be in the U.S.? Is it going to be outside the U.S.? That's not good for the economy, and it's not good for the markets, at least in the short term.
But, you know, it just seems that this continued emphasis and heavy reliance on monetary policy as opposed to fiscal policy, I don't see that changing, and that, to me, is a negative, not a positive.
I think I heard, and it was Larry Summers was arguing that the central bank should almost not lower rates because they would try and force politicians to change their fiscal policy. I don't think that's going to be an effective approach. But yes, arguably, those are the two things that you would like to have working in concert. You know, monetary policy, trying to stimulate the economy, and fiscal policy, trying to stimulate the economy. But certainly, the fiscal policy doesn't seem to be going that way outside the U.S. And given the current dynamics in Washington, not in the near term in the U.S.
Bottom line is there's more risk.
Comment. It seems like, you know, with interest rates low, price of risky assets high, uncertainty in the world economy, and us having a long-term asset allocation right now that's trying to get 7.25%. That last thing doesn't work with the first three, at least in the short term.
Well, it may, right? I mean, this is one of the things that, if you go back and look at war periods, right, which, I mean, arguably that's what we are, and I think that's what you have to behave, and those are the big periods of interest rate pegging, right? There are assets that do okay in those environments, and those environments can be sustained longer than I think people assume, but it's kind of like with 19 trillion, different assets have positive carry against those other than just other bonds, right? And it does kind of challenge you to say, what's that look like, right? Like in that world, gold has positive carry. In that world, crypto has positive carry, right? Those are two assets where we traditionally haven't played, right? But they have positive carry now, right? Against 17 trillion in negative rate debt, right? Those are not very big markets that can become very big markets if that world's sustained, right? And so, I mean, and stocks don't necessarily do poorly, right? I mean, some of that depends on the outcome. I mean, back to the outcomes of conflicts matter, right? But, I mean, I do think it challenges the thinking, right? Or are there ways to, this goes back to the options thing, change the structure of our, like if I have a company with no debt and I lock in that return stream pretty closely, is that a bond or is that an equity? I don't quite know, but I know what that return can look like, right? I mean, we've gotta use the option market to do it, right? But there are things I think staff needs to be thinking about and we need to be thinking about a little bit differently if we believe this world's gonna be sustained, which the rhetoric suggests to a degree that it might, right? But I don't necessarily think that's poor for stocks. I think it's poor for bonds, right? I mean, a pegged world at 2, and we got the requirement to keep 30% of our money there, right? I mean, we really ought to be thinking that's just our collateral pledge to get the exposure that we really want, right? Because we're not gonna make any money on it.
Well, I guess that was kind of where I was headed, and I don't have the answers, but maybe, as you say, we need to be thinking, thinking about new ways or ways we're not currently doing it to achieve some return, other than just the bottom, moving some fixed income into cash. And I'm sure Jeff's doing that, we're just, yeah.
Love to borrow heavily at negative yield. Be an ideal strategy, so.
Yeah, but I think the dilemma we face, Bill, I think it's the fact that under what we're facing and possibly facing is we have relatively few options. There aren't very many things that you can do. If interest rates continue to drop and we have negative interest rates, we're gonna be really struggling. There's not gonna be very many alternatives.
And I would say that's why a lot of your peers throughout the country, we see continue to look closely at their expected returns and what are realistic. So some of it is exactly that kind of adjustment. All of your peers, and we know that you and your staff continue to look at that. It's an important thing to be realistic. There's only so much risk you could take on to try to make it work. At a certain point, you have to just say, we can't take any more risk. We just need to lower expected return.
Exactly.
But I think we should take a little bit of step back and remember also that the funding policy for the pension reform was predicated, Mike, it was
Basically, it's 4% a year, earning 4% a year until 2021, and then assumes that the assumed rate of return will drop to 7 in 2021 and remain there to earn 7.
It's a quarter point, but
Quarter point.
yeah. But it's predicated on a period of lower returns. Presumably that was going to be sort of a quasi return to the mean, from a valuation perspective that would enable, but we're not there right now.
Well, and I think, following up on, sorry, Ed.
No, I was gonna say, one of the things that stands out is the fact that under ERISA, private pension funds not only are substantially better funded at something like 87% fully funded, but the fact of the matter is they've achieved it not so much through returns, but through increased contributions. And that simply has not been the fact in our public pension funds. So that's something that's gonna have to be seriously considered if we go down the path of what we're talking about. I mean, I don't see that you're not gonna be able to get it out of returns. There's some private pension funds, if you look at them, that have very little equity exposure and virtually almost 100% fixed income, but they've been able to maintain their status through increased contributions. I mean, we see corporations every year adding to, in a lot of cases, adding to their contributions to their pension funds.
Yeah. I think a key feature about the corporate plan that is distinct from the public plan is that they can go to the debt market and borrow money to buy back shares or borrow money, fund their pension fund. They have access to that kind of a mechanism to improve their funding. That's a lot harder in a public setting. A willingness to take, and they borrow it, call it 3% maybe, our cost is 7.25, and that's what it is. So it's a little harder, I think, for states to kind of go and hit the printing press, in order to bring capital in the door, in order to fund the plan. It has to be more of a, ratchet the contribution rates higher over time, both on the employee and the employer historically. So it's a different mechanism, and I do think that the legislation that was passed a couple of years ago does a tremendous amount, to move us from, where we've been from a funding kind of protocol to where we need to be. I think the General Assembly deserves a lot of credit for recognizing the gravity of the situation. And
You're talking on a $10 billion payroll, $856 million additional dollars annually in contributions, when all of the contribution increases are phased in on the employers. That's a significant commitment that the General Assembly's made on behalf of the state and also on the locals, but it's also a significant commitment that they've made on behalf of the state and the various all the other employers that have to participate in funding of the system. I think the thing that I think is kind of in our evolution as an agency, I think we are much more attuned now to managing the portfolio in concert with the requirements of the plan. So I think we're much more mindful of, what it takes to make, ultimately, our job is to earn the way benefits get paid is contributions plus investment returns equal benefit payments. Our job is to solve for the investment return piece, in essence, knowing what the contribution policy is. So, but I think we're doing a much better job of linking our asset allocation to the actual risks of the plan and the way that we manage the plan and the liquidity of the plan. But I do think, and I want to talk to the commission about this a little later, I do think that there is room for us to do a little bit better job of the way that we communicate to the General Assembly about the amount of risk that it takes to get what they expect out of us on the return side. That you don't get return without risk, really, or not much. You don't get enough to make the plan work, by far. But that's a conversation we'll have a little later.
If there are no additional questions, I'll turn it over to David.
Good morning.
Morning.
So today I'm going to go through our fiscal year end performance ending in June. So the plan returned 5.84% on June 30th, with the policy benchmark returning 6.5%, giving us a negative 66 basis points of excess return. Looking at that performance in dollar perspective, you can see we started the year at $31.3 billion. In that time, we paid out $1 billion of net benefit payments and had $1.7 billion of investment performance. So we increased the plan assets by $674 million to just under $32 billion. Looking at our market value through time, you can see ending the year at $32 billion. We're up about $2.7 billion from the trough in December. Since RSIC's inception, we've increased plan assets by $6.4 billion. In that same time, we've paid out $13.5 billion in net benefit payments. Looking at our portfolio exposures relative to our SIOP targets, you can see since last time, that overweight to equity, we ended the year bringing that back to target, and we're maintaining an underweight in core fixed income, offsetting our overweight in liquidity and cash. Looking at our gross of fee Bank of New York universe, you can see our rolling 1-year percentile ranking was 62nd percentile, our rolling 3 years was the 83rd.
David,
Yes.
go back to, the one thing that I wanted to make clear, because earlier we referenced the investment metrics universe, and that, I just want to make sure that we're clear on the difference in those universes. What Bank of New York gives us, just a reminder for everyone, is a gross of invoice fees universe. So comparing us to, I believe it's 34 other plans that are greater than $5 billion that are custodied at the Bank of New York, right?
That's correct.
And the thing that I think that we found is, in that universe, we were playing football. Some people score touchdowns 9 points. Some people score touchdowns at 6 points. And some, somewhere in between, right? The net of fees universe that Investment Metrics and that Makita has included in their materials for a while is a net of all fees universe. And I believe that it's made up of 30 plans that are greater than $5 billion, so 4 or less plans. Some of those may be Bank of New York plans, some are, but it's 30 other pension plans that have greater than $5 billion in assets. And in that net of fees universe, the median return is 5.8, right? So we're right at the median. Okay. I just want to make sure that was clear, because I would submit the apples to apples comparison is the investment metrics versus we don't know how much invoice fees other plans have in the Bank of New York universe.
That's correct. So looking at performance for the year, and just focusing on the beta returns for a moment, real assets performed very strongly, with public real estate returning 11.2%, infrastructure returning 12.7%. And kind of on the other end of the spectrum, you can see cash only returned about 2.6%, and our portable alpha hedge funds excess return were about negative 13 basis points. And that's excess return over LIBOR. And kind of looking at each asset class's excess return, you can see our opportunistic asset class beat the benchmark by 1.84%. Equity options, even though, as Jeff alluded to, the beta was disappointing and under equities, our asset class implementation outperformed by 77 basis points. And our public real estate outperformed by 75 basis points. And again, on the other end of the spectrum, our hedge funds excess return over LIBOR underperformed that static 250 basis point benchmark by 325 basis points. Our private debt implementation underperformed by 140 basis points, and mixed credit underperformed by 133. So looking at our absolute return on the x-axis, our excess return on the y-axis, and the bubble sizes being the planned AUM, you can see our asset classes outperforming their policy benchmark. We're about 26.6% of the plan, and they outperformed by a weighted average excess return of 66 basis points. For the underperforming asset classes, about 73% of plan assets, and they underperformed by a weighted average excess return of 94 basis points. So moving on to our attribution or our contribution to the plan's excess return. Again, you can see those positive contributing asset classes, so core fixed income, equity options, public real estate, tips and other opportunistic, adding a total of 25 basis points. And then pulling down our plan excess return, you can see our portable alpha collateral detracting 27 basis points to the policy benchmark, followed by that cash overweight detracting about 35 basis points, and private equity detracting about 10. Just looking at this visually, you can see the allocation effect in the gray bars, the selection effect in the blue bars, summing up to our total plan's excess return of negative 66 basis points. At this point, I'll pause for any questions.
Thank you, David.
How many pages yours is? Okay. All right. I am going to be as economical with my comments here as I can be. As a reminder, this is the statutory review of progress toward AIP initiatives. AIP included 34 different goals, a lesson that we've learned. 28 of these are investment team goals. 16 of those are single-year goals, 12 are multi-year ongoing initiatives. Also have other initiatives from reporting, IT, and legal department. So as a reminder, the way that we're structuring this to make it as easy for everyone is we're going to review changes from prior meeting. So here we have 4 updates. We completed our work evaluating whether equity option strategies are as compelling outside of the U.S. Over time. We believe that what is present in the U.S. holds globally as well. As luck would have it, after we had completed all of our work, the CBOE released a white paper and a first ever global options-based benchmark index. So we got to the finish line and could have just waited for them to do the work for us. But we're better off for having done the work. Currency hedging, I think we neglected to point out that Makita had taken the reins on this and presented this, I believe, at the December meeting last year. So we have marked that completed. Now, we did not make any decision, but that is the kind of thing that I think we need to spend more time with in order to arrive at a decision that works for all the commission. Another project completed results in our being able to track and compare metrics across both public and private credit transactions. Benefits abound, but the benefits that are most valuable to us are that it helps us understand the quality of underwriting being done at firms because we see the actual transactions. And then finally, and this is Brian and his team that have worked on this, developed a scorecard system for active managers in public markets. We can not only see how well our strategies perform against benchmarks, but also against similar strategies. And this incorporates a bit of a utility function perspective where we express a preference for consistent performance, avoiding bottom quartile outcomes, but it's a neat project for us. Let's see here. And one of the most interesting things is we treat the index like it's a strategy that needs to be assessed as well. So we're able to assign a grade to an index as well, and that's been an enjoyable thing for us to look at. As far as ongoing initiatives, our practice here is to highlight where not just things that are completed, but where we feel we've made progress. I don't want to spend a lot of time on this, but 3 of these are completed. Most noteworthy as it relates to the portfolio is that we are free of some hedge fund investments that we have been working our way out of for quite some time. And that is something that Brian and Justin have been very diligent about achieving for us.
Is that entirely the so-called low beta hedge funds?
No, these are legacy hedge funds that go back even to you know what the earliest of those was? Not just simply the low beta hedge funds.
The big ones from like 2011 when we did the hedge fund senior strategies.
Yeah, so,
Those have all been fully redeemed now.
this is one where I'm offering an olive branch to our reporting team here because their nearing completion would have been completed were it not for Mike and I taking us down the path of this reporting framework. So they had done what they had set out to do, and then we brought a different way of approaching performance reporting and dropped that right on their doorstep. So we are nearing completion on a number of elements of that, and I'll hit that when we get into the framework. But let me pause here and see if there are any questions before I take us to the delegated investment report. Hearing none. Mr. Chairman, pursuant to our delegation policy, I would like to make note of the fact that we have closed 2 investments since the meeting in June, and they are on the screen before you. As we noted in materials provided to you all before these investments closed, we have established a joint venture with a BDC named FSKKR Capital Corporation. This is a $125 million commitment in our private debt portfolio. We know this credit team very well and have invested with them in some other products historically, and are excited to be able to build on that relationship in a way that is economically advantageous for us. We have also made a $55 million private equity commitment to Great Hill Partners Fund 7. This is a new relationship for us. It is a buyout and growth strategy, and we're very excited to have access to this fund, and are very much looking forward to building exposure with what we regard as a very talented firm. So I will pause there, but Mr. Chairman, this concludes my prepared report.
Do you have any questions about the delegated investments?
Well, Jeff,
Yes, sir.
I think you're probably aware of it, but the fact of the matter is that any of these, with the amount of lower quality debt financing, I think we ought to be very careful and continue to monitor to make sure that any of the investments that we participate in, that we avoid this so-called covenant light stuff, that we get into this whole syndrome of giving away the store and putting us in a very subordinate position. So I think that it's particularly at this juncture with the amount of financing that's going on.
We agree, and Ed, I'm happy that you bring that up, because that's been a major thesis for how our private debt portfolio has been changing over the past several years. Less mezzanine, things where you're subordinated in the capital structure. And we've been focusing on senior secured lending. And one of the reasons dovetails nicely with your remark is that that's been a space where you can still get covenants in the loan documents. So that's our attempt to do exactly what you're describing. So, all right, Mr. Chairman.
All right, thank you. Let's see, Mike, are you introducing Makita?
I am. Thank you, Mr. Chairman.
Thank you.
Mr. Chairman, we're excited to have Mr. Peter Woolley with us from Makita, co-CEO of Makita Investment Group, joining us again. He's going to give us a presentation, an educational presentation on collapsing global interest rates. I think Peter and I have had the opportunity over the interim since our last meeting to to talk on several occasions about how we can improve both mutually improve the relationship with Makita. I am very excited about the direction that I think that we're heading in with the relationship. One of the things that is a direct result of this is the presentation that you're about to receive, where we're really, I think, going to be able to more fully explore and exploit the full capabilities of Makita. And I'm excited to do that. And I think you'll see as we get into the strategic calendar presentation, we're going to build in the opportunity to receive these types of educational topics on a meeting by meeting basis. So very excited about the kind of the refreshed direction of the relationship, and I think it's going to be mutually beneficial for both firms. So without further ado, Mr. Woolley.
Great, thank you. And so I want to reiterate that we appreciate the feedback and are excited about your approach. And, you know, candidly, we work with almost 400 funds throughout the country, and a lot have different approaches, and some of them really just look for their consultant to deliver a quick report and get on, and then so they can get on with the meeting with lots of other things on the agenda. The most fulfilling engagements and relationships that we have in partnerships are ones where they take the approach that you have, where you're looking for more engagement on our part, more feedback. And so that's what we're gonna look to continue to collaborate with staff and bring that to you each meeting, to plan out if there are research topics that we think are timely and appropriate, to bring those to you. And if we have research specialists covering different topics that we have throughout the country, throughout the world, to bring them in for some meetings. And so some of those things we'll plan in advance with Mike and Jeff and your staff. Other things will be hard to plan because there'll be timely things that just come up 2 weeks before a meeting, but we'll try to work closely to be able to hit on some of those topics. So we're really looking forward to it and appreciate the feedback. So this is an example of a pretty timely recent thing. This is a piece we put together just over the past few weeks, and it's on collapsing interest rates. There's a lot here on the summary page. I'll just hit on a few things, and I'll try not to reiterate too much of what Jeff covered in his piece, but rates have fallen to what are now historical lows. The yield curve has inverted, and we have some slides there where we'll talk a little bit more about that. And so it has implications. We spoke about it a little bit, but I'll hit on some of this a little bit more. It has implications for future returns. It also has implications for the economy and the stock market. And so we'll talk about some of those in these next few pages. So this gives, page 3 gives a visual of the 10-year Treasury yield for the past 70 years, 65 years, and you can see it peaking in the middle there in the early 80s, around 16%, and you can see it now in the current falling below 2%. And so just last month, rates fell to 2%, and that was the first time in about 3 years that they hit that level. But then quickly after hitting 2%, they fell another 50 basis points down below 1.5%, down to 1.47%. They've risen a bit since then, up to 1.7, but still well below 2%. We're talking about historical lows, and if you look at it from a percentile basis, the 99.9th percentile of low returns, low yields for interest rates. And that certainly has a problem for future returns, directly because 10-year treasuries and other bonds that price off 10-year treasuries are in your portfolio, and they're basically a big part of the opportunity set that your managers are looking at. But it also has follow-on effects for many other asset classes, and we could talk about that as well. So this next page, this gives a good summary of return expectations. And Ed, I know you asked about that, and there are a lot of answers about it because some of those are longer term answers, like what are your expectations for 20-year returns if rates go down this low? But this page also covers what happens to bonds immediately or in the 1 year period after we have rates either rising or falling. And so, I think a good starting point would be the column where it has a zero, total return given changes in interest rates. So let's assume no change, a zero change in interest rates. You can see what we have is rows for short-term treasuries or cash, 1 to 3 year treasuries, intermediate treasuries, and long treasuries. Across the board there, you're looking at 1.9, 1.7, 1.4, 1.9. So what to expect? If interest rates don't change from here, you should expect less than 2% a year for pretty much any bonds across from cash all the way out to 30-year treasuries. But then the other interesting thing that, Ed, you asked about, well, what if rates go negative? Trump's asking for rates to go to zero or maybe beyond. A lot of folks at the Fed say they've looked at that, they question whether that would have much of a positive impact. They worry about a number of problems. One is, could create big problems for banks. And the other problem is it creates challenges for savers, individual savers and retirement system savers. So they recognize that it creates big problems for you and all the other retirement systems throughout the country. Especially if there's questionable effects, positive impact from that. I think a number of the Fed have done studies and are leery of doing that, of just dropping rates. So it is something, though, that if you look at the rest of the world, we saw the stats earlier, 15, 16, some days it pushes over $17 trillion of bonds throughout the world have negative yields. So it would not be shocking to people if rates went lower here and perhaps at some point went negative. I mean, that's where they've been for 3, 4, 5, 6, in some cases 7 years in other parts of the world, Europe and Japan.
But doesn't that imply a forecast of lower growth?
It does. I mean, and that's one of the other. It certainly suggests lower growth. It suggests lower inflation expectations. So I'm not suggesting that this is a good thing. I think Jeff hinted that maybe we'd have a short-term bump in the stock market because the stock market might appreciate. That might stimulate the economy, and that if you're looking at the cash flows that companies kick off, the dividends, the lower the interest rates are, the more valuable that dividend stream is from some companies. So there might be a short-term boost, but longer term it has very negative implications, very directly on the bond side, but also it suggests significant challenges and headwinds for the economy. But also, to answer your question more directly, well, what if we do see rates drop that much? Look at the first column there, which is minus 150. So that would be if rates dropped 150 basis points from where they are right now. That would be a big drop. They'd still be above Europe. But there you'd see, cash, short-term bonds, 2.4, 4.4. Your intermediate bonds would earn 7.5%. Long-term treasuries would have a very strong gain, 34%, if we had rates drop another 150 basis points. So if we had some of those extreme rate cuts that went across this spectrum, not just central bank cutting, but treasury rates falling as well.
But isn't that the thesis behind what's happening in Europe, where people are paying banks, where they're getting negative interest rates, but in anticipation that at maturity they'll get back, even though they're getting a negative interest rate, they'll get back more principal?
Well, I think they're not. It would be a negative interest rate, but there's not more principal. I think they're just assuming that if there's low to no inflation or negative inflation, they're happy just to get their principal back, or slightly less than that if you have a negative interest rate. What you see there is most of that is in debt, so that's in but not in savings accounts at banks. So if you're buying bonds in Japan and Europe, Germany, the rates are negative across the board from cash all the way to 30-year bonds there. So those are bonds if you're an investor and you're buying bonds. If you're a depositor at most banks, individuals, most banks still have either zero or positive interest rates. There's a lot of debate in some countries about can they force negative rates. And so there are debates about whether that will be allowed. Some banks are saying, we never did that because we thought this would be temporary. But in some countries, it's been going on for 7 years. And you have a bank president in Europe right now, one of the largest banks, saying, we think this could go on for another 8 years, and we feel like we can't absorb this for 8 more years. But they're looking into whether or not they'd be allowed to pass that along and have a negative rate. They're worried about implications about runs on the bank. So if you do basically tell people say, you're gonna have negative 50 or 60 basis point return, people will say, well, why don't I just take it out, put it under my mattress, literally. And so there are a lot of debates there. This has been going on for years, but it's accelerating right now because I think a number of folks are realizing that this is not necessarily gonna be a temporary thing that's gonna reverse it. But that answers your question if rates get cut. Short term, it's positive in that you have higher returns out of your bonds. Instead of less than 2% that you see in the zero column there, with rates not changing, you have rates, you have returns of 2.4, 4.4, 7.5, or 34%, depending on the duration or the maturity of your bonds. So that's a short-term positive. The longer-term negative, though, instead of then saying for the next 30 years, you should expect, maybe almost 2% out of your bonds or cash, you have to then readjust after you get that short-term gain to say, now we probably should expect 0 out of our bonds for the next 30 years. So then the other thing I would highlight on this page, if you go to the further right, like the 250 side, well, it shows you how much less you earn if rates rise in the short term, or how much you actually lose in some bonds. So if rates rise 250 basis points, you could see short-term bonds down 3.2%, intermediate bonds down 7.6%, and those long-term bonds down almost 31% if interest rates rise. So in some ways, it would be beneficial for the retirement system if rates rose gradually, so that we could be back to an environment where you can hold bonds that earn 5 or 6% and feel like that's not far off of the 7 that you need. And then you could have other assets just above 7 that could offset that. But to get there will be painful, especially because rates are so low right now. So to get there, if rates rise to 250 basis points, 2.5%, just intermediate bonds lose 7.6%. And for folks that hold longer term bonds, devastating losses of almost 31%. So there's a lot of information here. The one last column I'd share then is the 150 column. If rates rose 1.5%, that would really just get things to where they were about a year ago. So you expect to lose about 4% on an intermediate bond portfolio if rates just rise over the next year back to where they were a year ago. Anyway, this gives a lot of information here. I tried to highlight just a couple of the scenarios to answer questions, but also just give some candid feedback on the concerns for future returns given where rates are at. All right, this page 5 gives a visual of the yield curve inversions. And so I think you probably have heard since March a lot of talk about yield curve inversion, and a lot of people panicked about it. And so just for quick context, generally the yield curve is upward sloping. So short-term bonds have lower yields than long-term bonds. Basically, if you're going to own long-term bonds and be locked up for a longer period, you generally are able to get a higher yield for that. So that's an upward sloping yield curve. That's how it generally is in most economic environments. An inverted one is when it's the opposite, when the short-term rates are higher than long-term rates. And so we saw that at first in March when we were looking at just 3-month treasuries. were higher than the 10-year Treasury. The more closely watched measure, though, is the 2-year Treasury versus the 10-year. And that just inverted last month. And so basically, if the 2-year Treasury gives you a better yield than the 10-year Treasury, and so, the question is, why are people all worried about this? Why are they all hyped up about this? The last 7 recessions that we've had were all preceded by an inversion, a yield curve inversion. 5 of them are shown right here. You could basically see every time that red line goes below 0, that's a yield curve inversion. And you could see generally, not immediately, but soon after, on average 16 months after the inversion, we've gone into a recession.
And the inversion can just be one day, because we're not inverted today. It would seem like it was only inverted about a week or so.
Well, exactly, and so that's where, this is, the level of confidence that people have in this is how long it stays inverted. So, and the other thing I would put in context, though, some people feel like, and this is, it's a dangerous comment, some people are, some economists are saying, well, this time it's different, which is always a dangerous comment to hear. But the reason they're saying is, number one, US rates are still well above rates throughout the rest of the developed world. And our central bank and other central banks are much more active right now. And they feel that might make things a little bit different right now. So we've already had a cut, we're probably gonna have another cut pretty soon. If you make a couple of quick cuts, you can get rid of the inversion.
Yeah.
And so that's why some people say if we make a couple of quick cuts, perhaps the inversion goes away, and it's not like some of these other periods where you sat for 12 months inverted. But so it's a good point. There's no guarantee that this means it. A lot of people are worried about it because it has preceded the last 7. And they feel like it's a tipping point. It's a tipping point in the economy when that happens. Because the market is basically pricing in that there's going to be lower growth and lower inflation. And therefore, they're pushing down the yields, bidding on prices and pushing down yields of some longer term bonds.
But isn't it also, it seems to me there's a little bit of well, first of all, we know that inverted yield curves very often do precede a recession at some point out. I think you mentioned, what, 6?
Average of 16 months, yeah.
16. But isn't it historically also true that within 6 months after an inverted yield curve that stock markets have generally improved?
I don't have stats on that, but I don't want, what I'm sharing with you is, I think is similar to what you're saying. I'm not sharing this with you to get you overly worried about the yield curve. I'm bringing it up because it's out there, you're hearing about it all the time. Some people are hyping it more. I'm actually probably trying to bring the hype down a little bit. It's saying that a lot of people are saying it's a really reliable indicator. I think that's questionable. That said, you see stats for 7 of those, and I will give you one other stat to your point, though, that I do have is the yield curve has been inverted for the past year or two in many of the developed markets in Europe, and if you look at the returns there, many of those markets had double-digit and in a few cases 20+% returns in the 12 months following those inversions. So there you look at it and you say, okay, so even if it inverts, does that mean take risk off the table and get out of equities? If you did that in Europe a year or two ago, you would have missed some nice equity runs. So this page really just highlights how much of a global issue it is. We're talking about how low interest rates are here in the United States, but they're much higher than the other G7 countries. I already highlighted, Germany. You can see 30-year government bonds in Germany, negative 14 basis points. So across the whole curve there, almost a full percent, minus 90 basis points for short-term for 2-year government bonds in Germany.
And Italy, who you could easily argue presents a much greater credit risk than the US, has a lower interest rate.
And so as much as interest rates have come down a lot, you know, some people say, well, they're still well above these other ones, and many people and many you know, many investors and many Europeans are saying, I'd much rather own dollars and treasuries than their local currencies and their local bonds. So a lot of people feel, and you know, from a trade perspective, from a number of perspectives, we're the world's reserve currency. And so as much as they've come down a lot, people feel like, given the context of where the rest of the world is, there is room for them to potentially come lower.
Does this have any indication that we should, you know, within proper guidelines, invest more in equity and debt in the US right now, as opposed to foreign equity and debt?
Well, that brings up a valuation perspective. And if you look at how expensive stocks are across different countries, US stocks are arguably the most expensive in the world because everyone's thinking the same thing we're talking about. Geez, things are a lot worse in other parts of the world. Let's buy US stocks, bidding up the prices of those. You know, and when you look at, you know, PE ratios, you know, the one metric that people believe is the most reliable indicator of future equity returns is a long-term PE ratio. It's called the PE10. And it basically takes, instead of just last 12 months earnings or the next 12 projected earnings, it takes over a full cycle and defined as 10 years. So it's a cyclically adjusted PE ratio. A lot of people believe that it is the most reliable indicator of future returns. When that gets elevated, they say stocks are so expensive, it's hard to get good future returns. The US is by far much higher than other markets. 40 to 50% higher PE10 ratio than most developed markets, maybe 60% higher than, emerging markets trade at maybe a 60% discount to US markets there. So on the one hand, there are a lot of things where you'd say, you know, where the US, the growth is stronger and a number of other things, but you're paying for that in some ways, especially when you talk about the equity markets.
Okay, thanks.
And so, you know, this hits, you know, Bill, on some of the points, you know, that about the strength of the US. This page here, page 7, really just hits on growth rates. You know, why are rates so low? Because we have low growth and low inflation expectations. And so consistent with that low rate environment, economic growth projections across the world are pretty low. The G7 countries averages about 1%. Makes the US 2.3% projection for this year look pretty strong. But you could see that declines across most developed countries over the next 3 years. I think I'll skip the next 2 pages so that we can, just for the sake of time, and really move on to page 10. And then this really just kind of summarizes with, you know, return expectations. And in some ways, we've hit on a lot of this before, so I'll be real brief here. With low interest rates, it leads to lower expected returns across all asset classes. Across bonds, because it's mathematical, right? You know, as Bill Hancock said, it's math. You know, it's if the rates are down and you just do the math on the coupons you're collecting. But a lot of other asset classes are priced off of those. And we and many other people project future returns with several different models. One of those models is building off of bond yields. So the lower bond yields are, that model just has lower returns for everything. You basically have a risk premium that you put on top of treasuries. How much risk are you taking? How much extra return are you expecting to get? With that model, for sure, across the board, has lower expected returns. You know, given how much rates have dropped over the past year, we update these things at least once a year. But we could see, you know, 6 months from now, when we go through the exercise with you at year end or the beginning of next year, looking at expected returns, certainly on the treasury side being 1% lower than we shared with you at the beginning of this year. But across the board, as that feeds into, not one for every other asset class, but it feeds in with different ratios. But we could see expected returns dropping at the total portfolio level, 50 to 100 basis points. Still got, you know, a few more months, see how things play out the rest of this year. But in some ways, we just want to be realistic about expectations and about where the market is and what we see going forward.
Thank you very much, Peter, for a report that's not necessarily good news for us as a pension fund, but appreciate the insight you've given us on that.
Thank you.
I think it's time for a break unless there are any objections. So let's take 10 minutes. And if you think of further questions for Peter, we can have those when we come back. framework.
All right, thank you, Mr. Chairman. We want to continue our recent discussions relating to the portfolio framework as well as the asset allocation conversations that we've been having. As a reminder, the portfolio framework seeks to align our performance reporting and performance analysis with the three basic investment decisions that we make. The asset allocation conversation, on the other hand, has focused on two concepts first introduced by Makita at the February meeting. One, whether it makes sense to simplify the policy asset allocation, and two, the notion that we should think about making changes to the policy asset allocation less frequently. We thought it would be most helpful to begin with a brief recap of the areas that we've discussed previously where we felt that we'd arrived at consensus prior to the discussion that's going to take most of the time today, which is benchmarking. So I will give a few comments, but Frank and Aaron, I believe, are both going to lead the benchmarking discussion. And then after they conclude, we'll finish with a brief review of our progress building performance reporting and talk about next steps, specifically as they relate to incorporating all of this into the policy documents, the AIP and SIOP. So during the past few meetings, we've gotten to points of consensus on a number of components of these matters, and I wanted to review them very, very quickly. The idea of restructuring our performance reporting in order to measure the investment decisions seemed very much to resonate with everyone. We also agreed that the 70-30 reference portfolio after the presentation from Makita is the right reference portfolio, the simple two-asset portfolio, equal in risk to the policy.
Jeff, can I ask a question there?
Please.
And this probably goes back to, I wasn't at the last meeting, but when that was discussed. But the June minutes say that the appropriate level of the risk for the plan will be determined by the reference portfolio. But the risk of the reference portfolio comes from the risk, as I understand it, comes from the risk of our current plan. So it seems like by creating that risk reference portfolio based on the risk of our current plan, we're assuming making a foundational decision in this new framework, which I like, that our current risk is the appropriate level of risk. And so I was just wondering if that's a proper assumption, or if there's what evidence, what reasons.
Sure.
And it seems like we need to document that in the SIOP or whatever.
Sure.
That why that is the appropriate level of risk.
And that's a very good question, and there was we spent a lot of time on this at the last meeting. It was driven, absolutely in part by an assessment of the current portfolio risk, but the real driving force for what made that level of risk the appropriate level was a discussion that James Wingo led for us, and it related to, and we talked a little bit about this offline since that meeting, the kind of risk limits for our plan, and specifically the risk of needing additional contributed dollars in order to make the system work. And this was we basically found a triangle area, and if we wanted to make sure that we're targeting a portfolio that will achieve the assumed rate while not taking so much risk as to create a higher probability of a bad outcome defined as needing to raise contribution rates, we focused on that as the framework for what is the right level of risk, and that's how we really got to this.
Okay.
So. Is that responsive?
I remember the slides.
Yeah.
That came with that triangle.
Yeah, we had a good bit of conversation.
Yes.
And I'm glad we did. Because that was how we got to the point where we felt we were ready to move forward with 70/30 as that reference portfolio, so.
I just think somehow that needs to be, because you probably don't want to put all the slides, a kind of a narrative description of how that works, how that was determined, I would think should probably be in our policy document.
Yeah, we'll include kind of the walk-up, I think it's good to include the walk-up as how, in the policy documents as to how we got there, a description of it, as to why we think that that's the right level of risk.
All right, thank you.
There was also broad support for reducing the complexity of the policy benchmark. And then subcomponent of that was a discussion about portable alpha. Area of consensus being portable alpha, the use of portable alpha is best categorized as an implementation decision as opposed to a policy benchmark decision. And then finally, all agreed on the importance of shifting our focus to an assessment of long-term performance evaluation periods. And we kind of arrived at the conclusion that made a great deal of sense for us. So that leaves us three main topics for additional focus today. We've asked Makita to lead a review of policy asset class benchmarks, most notably in private markets, which I'm going to preamble in just a moment. They're going to guide us through that discussion. We're also going to give you a brief update on progress in building a reporting framework, and then again, how we approach embedding this into the SIOP and AIP, and kind of a time frame for delivery for prior to the November meeting. So, question that has come up that I want to make sure we feature up front is why simplify the policy benchmark? I think we need to ask the question, what role does a policy benchmark serve? Policy portfolio is, frankly, the portfolio that we expect to hold unless we have conviction that looking different will improve returns or potentially risk, or frankly both. So to me, this is a question of perspective. Does the commission feel more comfortable with a portfolio that has a simpler asset allocation serving as the home base portfolio? As a reminder, we have 19 asset classes, 21 benchmarks embedded in our current policy. And the concept was to have a simpler expression of those, kind of roll that up into something simpler. And as Makita shared with us, using their asset class forecast, that could be accomplished without an expected negative impact to risk and return. In fact, doing so would have, actually, I think I misstated. The return would fall, I believe it was 1 basis point, which I am willing to sacrifice in service of the, I believe, 70 basis point reduction in risk. So principal, employ a more complex portfolio when we expect that doing so will create additional return. And the performance reporting framework needs to highlight when that type of decision has been made and provide a clear way of measuring outcomes from those decisions. So I'm trying to marry a number of concepts together there. It should also be noted that this particular flavor of simplification does something that I think is very valuable, particularly in light of the conversation we just had. The considerable bond allocation serves to improve the liquidity profile of the plan, enabling us, as opportunities arise, an opportunity to react to those opportunities. But let me pause here and see if there are questions, comments that we'd like to entertain.
Well, Jeff, I guess the question I would have, when we talk about these benchmarks, should we really utilize them as a method of comparison, or are they goals?
I would like to hear your thoughts on this.
So that was my, sort of my introduction to my section. I would say benchmarking is important because it lets you answer the question of, are we doing a good job? And to be more specific with that question, are we doing a good job at what? Are we doing a good job at asset allocation? Are we doing a good job with manager selection? Are we doing a good job with, you know, the tilts we're taking in our portfolio, either tactically or strategically versus those benchmarks? The right benchmarks, the appropriate benchmarks, let you answer those questions, and it's what Jeff just alluded to, kind of called measuring outcomes. So you're measuring, you know, things that maybe the board is more responsible for, the commission's responsible for, that asset allocation decision, and you're measuring what staff's responsible for. You know, the actual implementation decisions, how do they implement those asset allocation targets that you've given them? So I'd say benchmarks are used for, you know, again, to use Jeff's phrase, measuring outcomes, not necessarily as goals. That does not preclude you from still looking at different aspects from a goal orientation. You know, one of the things we're going to talk about is moving away. Some of your asset classes, you have what we call a plus a spread approach. So a lot of people invest in private equity because they hope to get the return of public equity plus something else. You know, they hope to beat the return of public equity. So plus some kind of spread, 200, 300 basis points. You know, that kind of implies that you're going to do that. I think that's still a great goal to have, but it's not necessarily the benchmark you should have. And I think when you do your asset class deep dive, something that Mike's going to talk about this with the strategic calendar, that's a good time to look at exactly those issues. Okay, great. You know, we've done, you know, our private equity program has done its objective of we've done well versus the opportunity set that we could have invested in, and how is it compared from an asset allocation decision that has added value? Yes, and how much value has it add? So I think it's for our purposes today, these benchmarks are less goal-oriented and outcome-oriented.
So Ed, you've asked a question that's the perfect segue into the next part of the discussion. So what question do we want a benchmark to help us answer? So I'm using the example of private equity here because when Frank and Aaron lead the discussion on benchmarking more broadly, I would like their recommendation for a change in how we benchmark private equity. So when I look at benchmarks, I try to think what question they help us answer, and I think that gets at what you're asking. When we think about our private equity portfolio today with a public equity plus 300 basis points benchmark, the question that we're able to answer is whether our private equity portfolio outperformed that goal. So that would suggest it's a goal benchmark. What it doesn't do is help us assess the quality of our implementation very clearly. So if we shift to a universe of private equity benchmark, as opposed to no matter what, your private equity portfolio benchmark is public equity plus something, which will always outperform. If instead you shift to a universe approach, you begin to be able to answer two questions that I think are both really important, particularly in the context of the performance analysis framework. How did generic private equity perform as an asset class? And then how did we do against that generic private equity? So that's, to me, the piece that's been missing for me. When I look at our private equity portfolio, I don't have that clarity into how well is it performing against the opportunity set of other private equity. I can tell very easily whether or not it's achieved that goal, as you outlined it. But what I want to do is I want to take you through an example here that I think helps lay out why I think that what Makita is recommending is more useful. So, and I apologize, this is not the easiest example to walk through, but I'm going to try to keep it as clean as I can. So consider the following. Over a period of time, doesn't matter what kind of time period we're talking about, we earn 14% in private equity. A broader universe of private equity, however, would have earned us 17%. Public equities earn 9, therefore our plus 300 benchmark would earn 12. So tell me if this is a good outcome, right? The current way of benchmarking it asks us, how did we perform versus public equity? And that's a perfectly reasonable way to approach it. I don't mean to indict the way that we do it, but and the answer is very clearly we outperformed public equity. We earned 14, and public equity earned 9. So we outperformed by 5%. That's it. We would feel very good about that. But by using the universe benchmark, we're able to break this down into two different assessments. An asset allocation assessment. Did the decision to include private equity in the policy benchmark improve its performance? Yes. Generically, private equity earns 17 versus 9. But how did we perform? Now we're responsible for that part too. And that is less upbeat. Our portfolio, and this is a stylized example before I get too far down this path. I'm not talking about our actual returns here. But in this example, our portfolio earned 14, not 17. So there are questions that are identified here that need to be probed. What's going on with our portfolio? But if we're living in a simpler world where it's just comparing private against public, which is a useful thing to do, don't get me wrong, but you're only getting one dimension of this. And I think that what Makita is recommending, makes more sense for us in context of our decision-based reporting framework that we're moving into. But I just think it just provides a lot of useful depth for you all to have an ability, and for me, frankly, to have an enhanced ability to triangulate on what's working and what's not working.
So Jim,
Yes, sir.
before we kind of proceed then, right,
Yeah.
from a board perspective, and this goes a little bit back to our conversation the other day, we can see why answering both questions is important to the evaluation, right? But some of this gets back to, all right, how are those reports produced and who's responsible for producing them? Is that going to fall on Makita? Is that going to fall on staff? And what's the infrastructure required?
So, so that is, we are building it now internally while simultaneously evaluating external service providers. If there's a software solution that makes this easy, then no one will, I will be the first one to that door, put it that way. But I mean, that depends on, what are we able to do? And that's, we're gonna hit in a little bit on kind of where the development of this is.
And then I'll ask the same question kind of Makita. I mean, one of the, Jeff and I were talking the other day, and I said, okay, we engage Makita as a board member. Is it my expectation that these types of reports could be produced from our consultant, or is this really something we need to build out? Because Jeff ultimately might need to even go additional layers below, right? But who, staff or consultant to get us at a board level to the level of granularity we need in our reporting infrastructure?
So we tend to skip over it every meeting, but we do produce a report.
Right.
Yeah, I think you saw I think Jeff flipped through it in about, 0.2 of a second.
Yeah.
But we do produce it, and we do a reality check of it versus, what staff produces. And from your perspective, as commissioner's perspective, I think that's what you want us to do. Because you don't necessarily need us replicating what they do, but you do want us checking, okay, or what they do is what staff's doing, is that accurate? Is it correct? Is it appropriate? Is it measuring what they're measuring? Is what they're telling us about those numbers also accurate? Or are they interpreting it the right way? And I'd see that as our role is, we are also a check on, those numbers and telling you, yeah, here's how we interpret that.
Is that responsive to the question? I want to make sure that we're not.
It is. I mean, one of my concerns, and maybe it's because I'm in the environment, right? Like, I'm able to cut my data out to 20 different ways, right? And yet we come in here and we seem to even struggle with being able to cut it 2, right? So maybe there's I don't know if that's an expectation, if that's environmental, right? But just, I give you that as background. I'm used to the click of a button being able to cut data 20 different ways at each level of granularity to isolate the impact of the decision, right? And then I come in here and we seem to struggle with being able to do it at 2 levels, right? Or what our reporting needs to look like at 2 levels. And so that's kind of just, I give you that as background to proceed.
So in this example, blown out into the framework here, so this is using the public markets plus a spread. The thing that I want to point out here is embedded in the policy benchmark is a public plus 300. Now, the value will, in the policy benchmark, would always be 300 basis points. There's no risk to that number. It is guaranteed because it's just a spread. It's always there. So what that does is it shifts all of the variance over here to the quality of implementation. And in this case, public or private outperformed public by 5%, 3 of which sits over here in the form of the benchmark, and we outperform by 2%. In the version of using the private equity universe, both sides have variability into them because the value of diversifying into private equity is not always going to be a positive experience. So this number can be positive, it can be negative, but in this example, it's extremely positive, 8%. And that shows up at where I would argue it should be, is in the benefit from having included that as an asset class beyond the 2 asset classes of the reference portfolio. And then over here, the quality of implementation, in this example, we have not performed as well as that generic world of private equity, and that needs to come through as a negative. In both examples, these 2 add to 5%. It just, you have a very different perspective on it. So I think this is a bit redundant.
Can I ask a question there?
Yes, please.
So maybe go back to the prior slide.
This one?
Yes. So if our policy benchmark was just private equity plus 300 basis points, what you,
that one.
Yeah, so if private equity could lose 20% but our value for diversification would still be up 3%.
It would be up 3 versus well, it would be, it would always perform 3% better than whatever public did. The benchmark would.
Right, and so private equity loses 20%, it still looks like our diversification decision is good.
Yes, because all of that shortfall moves over to the right side.
That doesn't show any value to us, does it? I mean, knowing that?
Thank you.
No, I'm just trying to, I mean, you know, we talk about simplification, I think this is, yes, the policy benchmark with 5 asset classes is more simple than an asset allocation with 17, but I think this whole thing is pretty complex. I'm not opposed to it. But, yeah, so I'm just trying to piece it together, so that's why I asked that kind of elementary question.
Yeah, no, I agree. That's why I believe that what Makita is proposing, it makes a lot of sense.
It's complex, but it gets rid of that problem, which is a big problem.
Yeah, that's a meaningless
Yeah.
bit of information to us.
Right.
Well,
Well,
I'm gonna stick up for it,
right?
though.
I mean, this group's taking a lot of grief for even being in private equity because it's perceived as an expensive asset class.
Mhm.
And being able to answer that first level of question is it worth the time and effort to be in the asset class?
Yeah.
It helps.
Yeah, but if it loses 20%, and that's shown, we gave it value at 3%, it didn't help us that year.
Sure, and I don't want to back up into the performance report, but I would encourage you, if you have free time, look back at our private equity's performance during the fiscal year at each point when we had a meeting. Because public markets were going bananas. And our private equity portfolio was just kind of methodically trending up to, I forget its return for the year, but call it 7%. But the perception, the policy benchmark, our experience as measuring our performance at the whole plan level against the policy benchmark is being whipsawed by this benchmark. Because what you're seeing in it is the volatility of public equity.
It's like,
It's not wrong, it's just I don't think that makes it very useful.
it's like 2,000 basis points peak to trough. I mean, trough to peak, basically, you know, think about and that's a significant swing.
So to Alan's question, I think if you're looking at it over a 5 to 10 year horizon,
Yeah.
that's a good comparison.
Okay.
But if you're looking at it from, on a quarterly basis, on a trailing 1 year basis, the gap between those things, as Jeff was saying, it just can get whipsawed so much. And he spends his whole time talking about that gap as opposed to, answering these questions, was implemented well.
So it's not that people who do it this way are wrong or deficient in any way. It works for them. But I don't think it works for this type of a framework where you're trying to separate out the real value from that diversification decision to have private equity in your portfolio. And then you want to also be able to assess, we have a specialty consultant, we have a team that's trying to, pick managers better than just that generic, private equity universe. And it's hard in context of those efforts to suss that out and give you all a useful perspective on that. But I think that this does a lot and helps, I like to joke that I'm giving the playbook that may ultimately lead to me needing to find new work. But, I think this is just, to me, it's just very simple. This aligns with decisions, and we need to be students of the decision-making that we have over time, study those outcomes, and adapt, when we need to. But we also, the other half of this is presenting it to you in a way that is logical and easy to follow, which is, our intense focus on how we build it.
Right. And I think, over time, like when we do if we stick to our knitting that we're trying to get to with this strategic calendar and we do our big 5-year asset allocation tear down, but we constrain ourselves to really doing it once every 5 years. I mean, there's nothing wrong with looking to ensuring that, because, I mean, the value of diversification, I think, from diversifying into private equity is the value of a enhanced return over what you would give the public, right? Because equity's equity at the end of the day, So it's the value of the enhanced return. So I think, looking at it, ensuring that we're getting a premium above what we could get very easily over that time period is a valuable comparison as well, right? I mean, because that's the whole point you're doing it is you're diversifying into it so that you get a better return than you can get for 1 basis point, basically. So if we're not getting that over longer periods of time, then that should question whether or not there's value in the asset class. But on a kind of a shorter term basis, are we doing it as well as everybody else? I think is a better comparison. Is our private equity program as good as what we could get from the universe opportunity set? Is a more useful comparison, I think, over shorter periods of time throughout that.
So at the end of the day, go ahead.
And that's just my comment, like, in a reporting infrastructure, it's not an either or, it's both and, so they give me both,
You can do both.
right?
Yeah, you can see whether or not, you should be able to see whether or not it's, it's earning a premium over, but you want to, as long as you're judging it over the right time period.
Correct.
And that's the thing that I think we got to get a little bit better at, is making sure we're judging these decisions over the correct time period versus focusing on either the fiscal year to date or the, just wild swings.
Well, that's where my question might have been, focusing more on like an annual return. On a 5-year return plus 300 might be fine. Yeah.
And, I think you'll see over greater periods of time, there's probably not a lot of discrepancy. There's not a tremendous amount of discrepancy between these two benchmarks over greater periods of time anyway, from what I've seen, kind of anecdotally.
We may hit on that
But we may, yeah,
in just a moment.
yeah, so, more to come.
So I don't want to belabor the point more than I already have, but answer one question or answer two questions. The latter method is the one that I personally am most excited about. But I will turn this over to Frank to guide us.
Just one other question before you leave.
Yes, sir.
If, under what you've just described, if we like measured against other private equity, if we underperform by 3%, what was it, 3%?
Yeah.
Would that indicate that we then would necessarily want to change what we're doing in private equity?
Potentially. You have to look at where is that underperformance coming from? That's the importance of seeing it first and being able to identify that as a question that needs to be asked. And then, either, we'll see it too, and we'll know that question is gonna come up. So we'll tailor, remarks, and in the kind of meeting planning that we have, we're talking about doing a very deep dive into each of the 5 asset classes, one at each meeting, and going really in depth, and that's where I think we would be able to show with a lot of detail, where is that underperformance coming from? And it could be top-down decisions, bottom-up decisions. Maybe it's because we had a 1.5 long period where we really didn't make any private equity investments because we had staff turnover and complexity there. It could be from a number of reasons, and maybe the worst of all, I would say, would be we chase performance. We try to invest in what just worked. Maybe that is the flavor that you see, and that is something that you would definitely need to change.
But also it would seem to me that probably the most significant element is gonna be manager selection.
Yes.
Yeah, that's the most important indicator.
Exactly. So.
All right, so I'm gonna walk you through the first half of our presentation, and Aaron's gonna walk you through the second half. What we're gonna be talking about for, I think, the third meeting in a row is benchmarking. but at a very different level, talking about benchmarking for this proposed framework. As I said, benchmarking is important because it lets you answer that question of, are we doing a good job? And it really allows for greater accountability. So in other words, whether you still want to keep Jeff around or not. Across our client base, we see many different ways to construct policy portfolios. And you may recall earlier this year, we presented a asset allocation survey we did of other large public plans. And one of the questions we asked in that survey was, how many asset classes do you include when you do asset allocation? And they were all across the board. There were maybe about a third of them had 6 or fewer asset classes, maybe a quarter of them had 6 to 10, and there were some that had as many as 20 or more. So there was no necessary best practice or most common practice there, but there were some that have the same or similar framework to you in terms of going to a more concentrated place. The bottom line, and this is going to be a common theme here, is that there is no industry standard. There is no playbook to say, okay, this is how you should do your asset allocation framework and your benchmarking framework. What we did for benchmarking, coming into this conversation, is looked at 2 things. Number one, we looked at what your peers do. So you may recall one of the first projects we did when you first hired us was look at what your peers do with regard to discretion, how much discretion you give to staff for private markets. We went back to that exact same group of public funds and looked at what benchmarks they use for their asset classes. And in particular, we focused on kind of the trickier asset classes, things like private equity, private real estate, private debt. And Aaron's going to walk us through that later. We also looked at, we were just talking about these fund universes. Jeff showed the example of the Burgess private equity universe. I should probably back up and make clear what we're talking about here. When you invest in private equity, the traditional approach is to invest in a private equity fund or private equity partnership. Now you have other ways of doing things because you're a very large pension fund. Jeff mentioned, for example, some of the the separate account you have with the KKR joint venture to do a BDC. But for the most part, you're going to be investing in private equity funds or real estate funds. And these are partnerships where other investors are going in alongside of you. There are hundreds of these funds raised every year, new funds every year, such that, for example, in the private equity universe, the 2 universes we're going to talk about the most have respectively 3,000 and 4,000 funds in them. We think the fund approach is a good one because it represents the opportunity set better than anything else we can think of. And we think the opportunity set is a great way to think of where your sort of baseline. Where do you start when you're talking about benchmarking? And I'm kind of taking some of Aaron's thunder here. What we found out when looking at their benchmark, is that number one, there are many different approaches to this. Number 2, there is no single best practice. And that each way of doing it has its pros and cons, and we're going to walk you through those later on. And in fact, what we think may be the best approach in some cases may not be something that's commonly used by your peers. Maybe it's because some of these fund universes are much more robust now than they were 5 or 10 years ago. So getting back to what are we talking about specifically today? Well, last meeting we talked about the reference portfolio. This meeting we're talking about the policy benchmark and the implementation benchmark. And if you look at, I think this is the pointer down here, this bullet point, they should really have the same benchmarks. Now, the way they're constructed will be with different weights, but they should have the same underlying benchmarks, the same indices that we're going to talk about. And that's what we're going to focus on today, is what those policy benchmarks are going to be. We're going to walk you through that and what our recommendations are.
Well, let me ask a question there. Policy benchmarks, there'll be 5 of those. But the implementation benchmarks, I mean, we may have another 10 sub-asset classes that will all have their own, right? So when you say the same indexes, I mean, we'll have a lot more additional individual benchmarks, right?
So I think you're gonna see two things. It will still be, and thank you for the segue, 5 asset classes, what we kind of agreed on, that's gonna be that level. And in order to be able to make that decision, and I'll go way back to Jeff's example here. If you had different sets of benchmarks here, you may not be answering the same thing. Now this is something we've talked about with staff. They probably will, and obviously they're still working on a reporting framework, have an additional level of benchmarking that's not shown here that does go down to the sub-asset class level. Because that's gonna let you measure, another thing that's not shown here is what we might call, think about public markets, the term in the industry is misfit risk. Let's say you want to invest in MLPs, but MLPs aren't in your policy benchmark. That is, in that sense, a misfit because it's not something that's included in your policy benchmark. That's where having that additional layer of, that extra layer of benchmarks comes into place. We're talking about the policy implementation benchmarks. There will be an additional layer. I don't think we've come up with a name for it yet. Mike's looking at me like, no, okay. That you will be able to dig that extra level down so you can say, okay, how do we implement at that level? To separate that decision of our tactical tilts and our strategic tilts versus the manager selection. So that is in the works.
Right, so I mean, each of, if you think about the, like if you flip to the 17, the big asset allocation. If we assume that, these are all going to be, they're in essence, the big 17 are rolled up into, or 19 are rolled up into the 5 bigger categories. All of these all have benchmarks, right? Currently have benchmarks right now, right? So the sub-asset class benchmarks, we already, for the things that we're going to use, we have a high yield benchmark already, right? So that would just, that benchmark, with all of those sub-asset class benchmarks roll up into the implementation benchmark, but then when we judge that versus, did that perform better than the 5 asset class, right? That's just a rolled up of that based on how we're allocated. And then what you see next is, did the managers that we hired beat those benchmarks on a rolled up basis? You get to see both.
Right, I guess then my question was, when it said the policy benchmark and the implementation benchmark should use the same indexes. I guess I don't understand what that is, because what everybody's agreeing in is there's different universe of benchmarks in the policy benchmark than the implementation benchmark. So there's different benchmarks, so what does same indexes mean?
So I'll use that as a segue. Of those 5 asset classes, the first one to maybe help illustrate that is the bonds asset class. So if you go back to here, there are essentially 5, there would be 5 components of it. The nominal investment grade, the treasuries, the TIPS, the mixed credit, the emerging market debt. All of that would now be rolling into bonds. So we would have the same, policy benchmark, implementation benchmark for bonds, but then there would be what we call a sub-asset class level. We could then say, okay, if you actually have an allocation to high yield bonds, here's what the benchmark is for that. Under the new structure, you may not have, staff may choose not to have an allocation to high yield bonds.
Okay, core bonds should be 1-to-1, but then the sub-asset classes will be additional.
Correct, yeah.
Okay.
Yeah. Right.
Okay.
If it's the same.
I'm slow, but I get there.
But basically, if whatever we're implementing is on benchmark versus what the policy is, it's the same. So like the private equity benchmark's the same, private debt benchmark's the same, and like the OVA, like what we could utilize within that bonds bucket, right? What is the same will match up, right?
Yeah,
So the
yes.
percentage of that we have the same, the rest will be comprised of whatever we're actually allocated to.
Yeah, the weight will be different, but the benchmark for the core bonds would be the same.
Core bonds will be the same, but we'll have a high yield benchmark that will roll into the implementation benchmark because we're actually using high yield or whatever it is at the time, right?
Thank you.
Yeah.
So now we've said that, bonds are actually a little tricky because there is no single index out there that encompasses everything you would probably want to invest in. The two broadest indices are the Barclays Aggregate and the Barclays Universal. And yes, these are significant overlap. As it says here, the aggregate comprises 84% of the universal. So basically, universal is the aggregate plus a few other things, a little bit of high yield bonds, a little bit of Eurodollar bonds, and a little bit of 144As. The high yield bonds are really the only thing of those three that you really do now. But neither one of them includes some things that you might want to invest in, things that you actually do invest in now, specifically bank loans, emerging market debt, and TIPS. So the downside is there is no one benchmark that includes everything, but the aggregate in particular is probably the one that includes the most of what you would probably invest in. I have a preference, and our recommendation is going to be for the aggregate over the universal for one reason, and that is I think it would be better to include assets that you're likely to invest in. Let me back that up. In the aggregate, everything that is in the aggregate is something you're going to be investing in. Everything that's in the universal isn't necessarily something you're going to be investing in. You may not be doing Eurodollar bonds. So I don't think you want to have something that's in your benchmark that you're not planning to invest in. I think it's better off to have assets outside your benchmark that you may invest in. It's a small difference, but that's my preference. So you're going to see in a couple pages for bonds, we're going to recommend the Barclays Aggregate. Private debt. So private debt's a little bit tricky. So just as I was talking about private equity, you tend to invest through funds and that kind of structure. Private debt, for the most part, has a similar structure. So the first thing we said was, okay, your current benchmark is a public market benchmark. So leveraged loans. So by the way, there's a lot of terminology here that all means the same thing. Leveraged loan, senior loan, bank loan, they all basically mean the same thing. It's loans to companies that are floating rate usually. This leveraged loan index includes publicly traded bank loans. And then, for your purposes, it has a spread, one of those plus a spread. So here's two things that we were just talking about for private equity. It may not be a great match. So we did the same thing we did for private equity. We looked at the underlying universes, the fund universes. And as Aaron's going to talk to you, there are two very large providers, Cambridge and Burgess, who provide private debt universes. We thought, okay, great. These are actually fairly robust. They have about 300 and 400 funds in them. Actually, it was 500 and 700 funds in them respectively. So we thought, okay, maybe these will be robust enough for us to use as an opportunity set for benchmarking. Unfortunately, as we dug in a little bit deeper, we found that these universes are composed primarily of mezzanine debt and distressed debt. So back to your comments from earlier, Ed, that tends to be subordinated debt. Whereas the way staff has put together your portfolio, it's primarily senior debt. So there would be a natural mismatch there. Yes, these are private debt, so they're not mark to market. So from that standpoint, it looks a little better from tracking error. There's that variation from quarter to quarter, year to year. But you would always probably be in a bit of a tough spot from a long-term standpoint because lower quality should, in theory, be getting a higher return. So it would be a different structure. So we decided, that wouldn't be the best approach. You'd be kind of in a perpetual penalty box if you used that. And plus, you go from having 500 or 700 funds to maybe 100 funds, and some of those are 5-10 years old. So it wouldn't be nearly as robust in that sense of what you really want. The leveraged loan index, again, a public index, it is a fairly appropriate. It is the most appropriate of any public benchmark. So high yield is fixed rate. Leveraged loans are floating rate. So the leveraged loan index is the best match to what you have in your private debt portfolio. The next question then was the spread. Is the spread appropriate? Again, Jeff's talking about we don't like that sort of guaranteed alpha, but here it's not really alpha because here we're talking about credit quality. So obviously if you're investing in a lower quality bond, you would expect to get paid a higher yield for it, and that's usually the way the market works. If you're investing in private loans, these tend to have a higher yield than publicly traded loans, because publicly traded loans tend to be to larger, perhaps more robust, more substantial companies, more diverse companies. And in addition to that, when we looked at our own capital markets expectations for what we expect for private lending, senior secured lending versus public loans, we have a spread of about 150 basis points in terms of the expected return. So that was consistent with where your current spread is, so our recommendation is no change. Stick with your benchmark there. All right, the next two categories are equities, and the easy one is really public equity. So global equity, this is all of your public market equities. So that's all your US equity, non-US equity, and even your equity option strategies. The great thing here is that the benchmarks that are available hit all of those criteria. If you may recall, 1 or 2 meetings ago, we talked about there are 6 criteria that you want to have for a benchmark. This is like the one asset class that hits all of them. Because you know everything in advance, it's all investable, it's easily reported on, you can replicate it, etc. So that's a great thing about these public equity indices. There are 2, and they're really, again, just versions of each other, that are the most suitable. And this is the MSCI ACWI and the ACWI IMI. The ACWI basically means All Country World Index. So this is everything. It is US, it is developed markets outside the US, it is emerging markets. So ACWI literally means all countries. And it is market cap weighted. So as a result, because the US is the largest market in the world, it's about 50%. The US is going to comprise about 50% of that index. Developed markets, about 35-40%, and emerging markets, depending on how they've been doing lately, 10 to 15% of that index. The IMI is simply an extension of the ACWI. That includes smaller cap names. So the ACWI is just looking at large cap stocks, so think of it as your S&P 500. The IMI is broader. It's something like the Russell 3000. So it includes and is dominated by those large cap names still, but includes 10, in this case really right now, about 12% of the index in smaller cap names. We think that represents the true opportunity set available to you, so we recommend the ACWI IMI as the benchmark for global equities.
Frank, I've got a question. In our reference portfolio on the bond side, we have I think our benchmark's gonna be Bloomberg Barclays US Treasury Index. So that's just a US index. Foreign equities really held us back this past year, and I know that's just 1 year. Is there any value or any reason we shouldn't just have a US equity index as our policy?
Yeah, so we talked about this substantially with staff. So first thing is, it's significantly lower diversification if you do that. And if you look at the way we model, just by being in these non-US assets, there are 2 things we want to take into account. Number 1, they're not perfectly correlated with US equities. So if you do that, you're actually pushing up the risk of the portfolio, of that reference portfolio.
Okay.
And number 2, you're lowering the expected return. And going back to Peter's point about earlier, US equities being by far the most expensive equity market in the world right now. So there are 2 trade-offs there, just from the risk and return standpoint. And again, we looked at it from the diversification standpoint, the opportunity set standpoint, the ACWI, the broad global equity market really representing the opportunity set for a institutional investor. We thought that was the most appropriate. I don't know if either of you wants to add to that.
One thing I think you covered it.
I
I'm avoiding the temptation,
I'll add.
personal growth.
Jeff mentioned policy benchmarks, kind of the home base. And home base is gonna be always global equities. I can't imagine any environment where they're gonna only have US equity in the portfolio.
Sure would help us this year.
Hindsight's 20/20, but.
Tends to go in decades.
Yeah.
For the last decade, that's
No,
been.
no,
that's been the
I
answer.
agree, not that we shouldn't focus on the short term, but.
Yeah, well, and I think that precludes the natural inclination to, if you have a more diversified equity, public equity component of that 70/30, it's one of those things that resists the temptation to do what just worked, right? That's because it would be, if you run 10-year return scenarios on 70/30s and 60/40s, all US, would be great, but that's not. That's hindsight, and that doesn't mean that that's what's gonna work. And if you look at capital market expectations, it would give you actually a lower return based on the capital market expectations right now. That's it.
All right, thank you all.
Next one is private equity. We've already hinted at this one. Your current benchmark is a public market index plus a spread. And this is actually a mix of US and non-US. It's kind of weighted toward the way the private equity universe is structured. About 70-80% of buyout universe is US, about 20% is non-US, and actually more European than anything else. So from a geographic standpoint, that made sense. But what we think of as a more appropriate opportunity set is that universe of private equity funds. So when we dug in on this, we looked at two universes in particular. Aaron's gonna walk you through this later. But the Cambridge private equity universe has about 3,000 funds in it. The Burgess universe has about 4,000 funds in it. So again, these represent a very, very broad opportunity set. Again, we're gonna talk about the pros and cons of a plus a spread approach versus the opportunity set or the fund universe approach later on. But to the question that Alan had earlier, you can still look at both, especially when you're doing the asset class deep dive. So I'm gonna kind of skip ahead and say, we're recommending the Burgess Private Equity Composite, and Aaron's gonna talk to you a bit more about that later on. Finally, the fifth of those asset classes is real assets. Real assets, we're combining two things, but really six things. We're combining real estate and infrastructure. But within real estate, and these kind of have parallel structures, you have core private real estate, non-core, so kind of like value-added or opportunistic real estate, and public real estate, otherwise known as REITs. Then you have a very similar structure in infrastructure. You tend to have core infrastructure, non-core infrastructure, and then there's also publicly traded infrastructure stocks. You currently have, for your real estate benchmark, something that's known as sort of the shorthand is the Odyssey, the NCREIF ODCE. I can't even remember what each of those things stands for. It's like National Council for Real Estate Investors. But essentially what it is a peer universe. It is all of the large core real estate funds are in Odyssey. So it does represent a true opportunity set for investing in core real estate. So from that standpoint, it makes perfect sense as a core real estate benchmark. The thing is, we're talking about more than core real estate. That said, core real estate is going to be the biggest component of this asset class, this combined asset class of real assets. The non-core is going to be very much driven by what's going on with core. There will be cycles, but it's going to be very closely related. And because they're private market, we think it's also going to be a fairly decent proxy for the core infrastructure assets. Now, there are only a handful of core infrastructure funds, so there's no equivalent peer benchmark there. We did look at peer benchmarks for non-core real estate and non-core infrastructure. The non-core real estate one is actually pretty robust. The non-core infrastructure one is getting there, may or may not be there yet. But if we wanted to have a benchmark that included each of the underlying components, you would need something that's really weighted to 6 different indices. Core real estate, non-core real estate, public real estate, et cetera, et cetera, et cetera. Again, trying to stick with that simplification concept, and similar to what we talked about with bonds, we decided let's pick the one benchmark that is going to be the most representative of this asset class on its own. And in that case, it's going to be the NCREIF Odyssey. And here's a nuanced caveat. The NCREIF Odyssey net Why does that come up? Because some plans report it gross, some plans report it net. The difference is about 100 basis points in the fees there. You have to pay fees, so, you know, the net index is really the one we think is most appropriate. So everything's summed up in one nice neat table, hopefully for you. Here's the 5, new asset classes. The current benchmarks, again, some of these were combining benchmarks from the past, there is no single benchmark, but the recommended policy benchmark is on the right. And overall theme is we're recommending using indices that really represent the best opportunity set in each asset class, while recognizing that for a number of these asset classes, staff is likely to implement them in a way such that there will be X benchmark investments. It's pretty much guaranteed in the real assets category and highly likely in the bonds area. And with that, I will hand it over to Officer Lally.
Thank you, Frank. I'll first say, don't get nervous about this 75 pages in this report. Got about 8 more.
Too late.
And,
Yeah, that already happened.
We included a lot of reference material for you, so you can show you how much work we did.
Give us your best dinner. Give us your best 60
Yeah,
seconds.
that's my thing, that's, I know about lunch, where's dinner?
12:22, so I recognize we're getting into lunchtime.
Yeah.
So,
And it's here too.
and I might say this a few times. As Frank said, this part, we've taken a two-pronged approach to the next step here, which is kind of a deeper dive into these private market asset classes, which are inherently challenging to benchmark. First question we wanted to look at is, what are your peers doing? So the same sample size that we used, similar size and larger that have granted discretion to their staff. So trying to get apples to apples to what you're doing. Frank mentioned that we are gravitating more towards these fund universe approach. So we do that, which universe or which vendors provide the best data set. So that's kind of part 2. So in part 1, what are the other plans doing? The short answer is no one is the same. Everyone has subtle differences across the board. We list here what we found was that the most common for each asset class based on what other peers are doing. And the intent is not to direct you towards what other plans are doing, but rather to be aware of what they're doing. And ultimately, in areas where we are recommending doing something different, the hope is we kind of guide and educate and explain why you're different, and you'll know the trade-offs that you'll need to kind of accept or be aware of going forward. So this is designed to be informative, but not forcing you down the path of what other plans are doing. Full list is listed way back in page 68 if you want to see them by state. We've got the 4 private market assets here, plus hedge funds, and then 2 pages of kind of thoughts, caveats, considerations. So I'm going to take them asset class by asset class and do a little bit of flipping. Private equity, first off, all 20 other plans have private equity, the data point itself, but extreme variety of how others are doing it. So the most common approach is consistent with what you're doing now, but we think there are a number of inherent challenges or limitations with what you're doing, but it's interesting to note that most are doing what you are currently doing. And as Frank alluded to, this is likely kind of just a residual effect of this was the easiest way to do it going back as some of these universes were less robust and less accepted. But within private equity, if they're using the public market plus a spread, there is no industry standard in which public market and which spread. So some use just US small companies as the public market. Others use just the US large cap companies. Others use the whole world. They were really all over the place. And the spreads were equally all over the place. So as low as no spread to as high as 500 basis points. So as we get into the kind of the pros and cons of this public market plus a spread versus the universe approach, you'll see that this is one of the major kind of drawbacks to this approach. But the takeaway on private equity was somewhat surprising for an asset class that has the most wide acceptance and been around the longest. It had the most varied benchmark. Private debt, peers were doing pretty much the exact same thing that you're doing, which is this public market plus a spread. So the leverage loan index plus anywhere between 100 and 200 basis points. You have, and we've recommended maintaining the leverage loan index plus 150. Interestingly, a lot of plans did not actually set a dedicated target to private debt. Real estate, most common was the Odyssey with no spread. And you could argue that this, the Odyssey is a fund universe, and it's been around for a while. It has wide acceptance and very clear parameters of what can go in it. So it is probably, those reasons are probably why many state plans have used it and adopted it. It's, it's got it kind of fails less of those benchmark criteria tests than some of these other fund universes. The devil's in the details, as Frank was mentioning. Some listed as gross, some listed as net, and most were kind of silent on that issue. So it's hard to truly determine what some of your peers are doing. We think the net version is most appropriate. It's more reflective of what you will get a net return. It's also more consistent with the other fund universe benchmarks like Burgess and Cambridge. Those are reported net, even though it's not explicitly stated. Finally, on the private side, infrastructure. Peers mostly went with the same methodology. Peers mostly went with the inflation plus a spread. You're currently using a public market index. Infrastructure is one of these newer asset classes where the universe approach, there hasn't been enough reporting funds into those universes to make them robust up until about now. So there is improved data out there, but historically there wasn't. So this is likely why most of the peers have gone with this inflation plus a spread. Hedge funds, most use the HFRI indices. This is in itself also a fund universe approach. So this is a hedge fund provider that gathers returns from various different hedge funds out there. So this is a fund universe approach, but there was a wide variety here too. And a lot didn't actually have a target to hedge funds. So how do you kind of summarize findings of what all the peers are doing? First, I'll say benchmarking private markets is tough. It's just an inherent limitation to an illiquid asset that doesn't price frequently, has no kind of public exchange for valuation. So the frustrations that you may have as commissioners, that I know Jeff has with kind of some of the historical benchmarks, those are shared by all your peers and by the consulting community as well. So the next slide we'll go through is kind of just understanding and accepting the limitations of the different approaches. But kind of the findings from the peers proved that there isn't some secret sauce out there that everyone's doing that we're missing. Everybody is all over the place and struggling with this issue as well. So, takeaway, as we kind of start gravitating more towards potentially using these fun universes, is that there is no right answer and wrong answer. You as commissioners really just need to understand kind of the trade-offs of the approach that we ultimately accept. So, to briefly kind of summarize, on the public index plus the spread, the number one advantage to using this approach is simplicity. That's why a lot used it historically. You can calculate it easily, it's easy to understand, and it's transparent. But you see a lot of cons, and we've talked about a lot today, and we've been talking about them for many meetings, which is, if you're adding this spread, that's a subjective number. How do you determine what is the appropriate spread? And, it's always positive as a result. So it's failing that one of the main criteria of the benchmark, which is that it's investable. So, second biggest kind of disadvantage of the public index plus a spread, we witnessed perfectly fourth quarter and first quarter of this, fourth quarter of last calendar year and first quarter this year, which is these public market indices are often way more volatile than the actual investments you have. So I know Jeff mentioned that in fourth quarter of 2018, your private equity looks great relative to a public index that's way down, but then that reversed significantly in the first quarter. So that's just noise. So that's one of the major disadvantages of the public index versus spread. As we lean towards using more of the fund universe approach, the biggest advantages we see are that it more closely resembles what you're actually invested in. And that's natural because it is a universe of your opportunity set. It's the universe of all the private equity funds or universe of all the real estate funds. So it's more realistic representation, we feel, of the investment decisions you make. Performance reporting is less volatile because you're only getting it quarterly, just like the way you get your reporting on your actual private investments. And then there is no built-in spread that is always there. So you're not starting in the hole, you could argue. But these are not.
Can I ask a question?
Sure.
Less volatile performance reporting under fund universes, but several of them have 3-month lags or, I mean, since we're looking long-term, are we just, really, we don't need to be concerned with a 3-month lag?
Your actual investments are also reported on a lag. So you don't have most of your 6/30 valuations until around now. So it kind of still lines up with what's actually in your portfolio. That make sense? So you're comparing more apples to apples rather than a time mismatch in terms of your actual investment and the benchmark.
So a traditional private equity fund, when it comes to June 30th reporting, what you're gonna see in the reports that staff produces, unless they're leaving the books open until September, October, is a March 31 mark, plus or minus any cash flows in between. That's the traditional way that what you're gonna see. So the underlying funds are gonna be reported on a market basis, which, because you're talking about a fund universe, the universe is also gonna be lagged for that same 3-month period. So in that sense, you are getting apples to apples as well.
Okay, thanks. Thanks.
Sure. So, we like the fund universe approach, but it is not perfect. The lag is something you do need to be mindful of. The other thing is, these fail a lot of those benchmark criteria tests as well, because it's not specified in advance. You can't invest in the whole universe, so it also is not the perfect benchmark. Sometimes the transparency is less than ideal in terms of what is the underlying exposure to all these funds. Because you're getting an amalgamation of hundreds or thousands of other private equity funds going in. So you can't just simply look at it like Frank talked about with the ACWI and say, all right, 50% is in the US, 30 is developed, and 20 is in emerging markets. It's more challenging with the universe approach. Consistent with what we talk about when you compare yourself against peer plans. It's hard to know really exactly what the peers are doing. Kind of put a summary on it. You just need to be mindful of the flaws in either approach. We see some advantages in using the fund universe approach, but like I said a few times, it is not the magic unicorn out there that's solving all the problems. If we're gonna go that route, the natural next question, step 2 of this analysis, which is only a few pages, is which fund universe do you use? So these are the 4 big ones that cover a wide variety of private markets. Cambridge Associates, Burgess, Preqin, and PitchBook. Cambridge Associates was for a long time the gold standard in private equity. It's kind of the first mover out there. Burgess is a group that has really improved their data set over the most recent couple of years. Is kind of where we're gravitating towards. The 2 on the bottom, they have a ton of information in those universes, but there's a flaw in how they acquire that information. So it makes them useful if you're doing kind of a point in time comparison, but less useful if you're going to do this on a quarterly by quarterly basis. So we kind of went through the analysis and determined that those 2 aren't really appropriate for what we're looking to do, and Cambridge Associates and Burgess are kind of the 2 finalists that would be more appropriate to use. So the 60 pages that we're going to skip go through asset class by asset class and all 4 universes. I mean, they look at things like how many funds are in the database by year? How consistent is the reporting by year? What does the end performance look like? What is the regional exposure? What is the sector exposure? And the conclusion is Cambridge and Burgess are very similar for the most part. In terms of number of funds, in terms of the end performance results. But we've kind of inched more towards Burgess for nearly each asset class, because they seem to have slightly more funds that are reporting into those universes, and a few subtle differences in certain asset classes. So in private equity, Cambridge Associates has a lot more venture capital exposure than Burgess, and it's likely a residual of kind of the endowment world that Cambridge used to work heavily in. But as a result, it's a little less representative of is the opportunity set that you have as a large state venture. So you're gonna not likely have that much venture as the Cambridge benchmark, so we lean towards Burgess on that. Lean towards Burgess in private debt and real estate with very similar results. And then infrastructure, the biggest difference is the geographic exposure. So lean towards Burgess because it has about half in the US, while Cambridge Associates is a lot more global, and your portfolio is probably gonna at least be half US in infrastructure. There's a lot there. I know it's lunchtime.
But the way to summarize it is really just going back to that slide that has the 5 recommended benchmarks. And then all of that was basically say, yeah, we did the digging, and oh, by the way, staff also looked at it with us to say, all right, Frank, we agree that, yeah, that Burgess makes sense as being the one we use for private equity for those reasons. Any questions?
Well, but then we get down to the sub-asset class level, we'll have infrastructure. Have we selected one there?
So that's where we would say, yeah, if we're gonna use the sub-asset class level,
Burgess
we
was
would recommend
recommended there too.
Burgess across the board.
Yeah, okay.
Well, thank you very much for your extensive report on benchmarking by asset class, and very helpful to our progress on the new asset allocation approach.
Do we pay those guys? Yeah, we pay them a lot.
I understand that lunch is here, and I ask that you defer any additional questions to after we break for lunch.
Mr. Chair.
Let's hear it.
We are focused on creating a streamlined reporting package for me and for the commission. We've been making progress, as you can see here on this slide. Mike and I want to be able to deliver to you performance reports in the new framework, beginning with the first quarter of the fiscal year. One of the things holding us back from the package we envision is that we are still working to onboard our risk system. As you can see at the bottom row here, the red X's. Also, the design of risk reports will need to relate to the structure of the policy benchmark as well. So we just need to have a little bit more time there to get ready. Green, just taxonomy here, green checks are we have designed and produced. Yellow means that we have designed it, but we're not sure that that's the final version. And in production, a yellow check would mean we have produced it, but we are trying to validate that it's being done correctly. So just wanted to share work in progress. Our reporting team is working hard and working effectively on this. And with the caveat of the risk system holding us back a little bit. This is the last of my section here. Our plan is to take the points of consensus, embed them into the AIP and SIOP documents in a way that will likely not resemble the current state of those documents. So there's going to be more radical surgery on those. We'd like to be in a position to distribute these by mid-October and receive feedback prior to the November meeting, so that ideally we'd be in a position to formally consider those documents at the November meeting. Mike, I'll defer to you if you want to add to that, but
No, like I said, the goal would be to provide you something well in advance so that we could receive feedback and be in a position to spend a significant portion of the November meeting discussing those and, seeing if we can ultimately get there. If not, there's nothing that prevents us from, maintaining that consideration or taking into account, significant, comments or potentially other ways of wording or laying out things. Because I think ultimately what we want to do is, we've got a lot of great slides that have walked us up to this point. To a certain extent, we've got to turn those into words. And ensure that we're capturing, the thought process, the deliberation process that we've gone through in order to get to where we are. So, I think there's going to be room for meaningful discussion and contribution to ensure that we're capturing all of that along the way. And that you can see that decision tree within the SIOP, and to the extent that it applies in the AIP as well.
And I agree with everything you said. I think seeing all those decision points will be very valuable, short-term and long-term. But, and I would just request to make sure one more is in there. I know in my discussions with staff individually, but also I think at the last meeting that I missed, I think it was in the minutes or in Makita's slide, that everybody's kind of saying, the research is changing the asset allocation frequently is not a good thing, and hasn't proven out to be accretive to return. So I think describing why we're changing again is an important data point to put in there as well.
Yeah, and then also including the requisite cautionary language as to don't mess with it after this, right?
Yes.
Just this one last time, right? That's the, and why, right? Yeah.
okay. Mr. Chairman, that concludes my section.
Mr. Chairman, I think it would be just to ensure that we're, I'm sorry, I don't mean to interrupt. Just to ensure that we're tracking, that I presume, I'm operating under the presumption as in regarding the benchmarks that we have consensus amongst the commission. So what we've discussed today we would be, as far as the benchmark portion goes, we would be looking to incorporate that into the documents that we provide you with. I mean, it's not, again, it's not necessarily a formal vote, because we've just been trying to build consensus with the ultimate goal of bringing everything back to you in a package. So, I just want to make sure that we noted that we're comfortable with the benchmarks as they were presented. And with the biggest change being the private equity benchmark going from a public market equivalent plus a spread to a universe style benchmark.
Yes, and so on an overall basis, does there continue to be consensus in all of the items that we've talked about, that the consensus has been reached on all of those items? Any
Can we,
queries?
for purposes of, let me qualify what we're agreeing to. For purposes of the AIP and SIOP, or for purposes of our general reporting for decision-making, right? Because the way I see those are maybe a little bit differently.
Well, ultimately what I see is that what we're proposing as far as the reporting needs to be captured within and kind of form the foundation of the AI, but the SIOP in particular. I mean, the AIP is a little different, but as far as like enshrining these concepts into those documents, are we comfortable with what we've discussed up to this point? I just want to make sure that I'm getting the right direction, so I'm producing the right documents on the back end. And then, I mean, you're gonna be able to, you'll have more robust examples of reporting by the November meeting too, so you'll be able to see what we're contemplating in regards to the reporting structure as well, like actual reports.
Well, that's what, until staff and us and the commission is comfortable that the reporting is gonna be there and be able to answer all those three questions. Maybe, until and I'm not sure when we're gonna be comfortable with that. We might see something, as you just said, by November. I wonder if it's wise to incorporate it into this COP and the AIP if we're still not yet confirmed that the reporting's there.
Yeah. Well, the kind of the embedded reporting structure is not really included in what in those documents now. So I think what those would reflect would be, we would incorporate we would build the bridge for the boxes. So, reference portfolio, policy portfolio, how the portfolio, basically the building blocks for the implementation portfolio. That's what I would see as in describing why we think those are good decisions, right? And how kind of a little bit of how did we get here, right? What we actually produce will be driven from, and to me, it's not necessarily one or the other. I mean, we should be considering should be considering all of it holistically as we move forward anyway, right? I mean, you've got basically break it down, you got the words and the pictures, right? The words are what's in the kind of the fundamental constitutional documents of RSIC.
Yeah, so can we go to that for just a second? So our legislation kind of gets to the point of why we have the reference portfolio to start with, right? I mean, we have two requirements, right? We have to have 30% more or less in fixed income.
Actually, we don't.
That's not in there
There's
anymore?
nothing, the interesting thing about it is, there's nothing about, we have a 70% limit on equity.
Yeah.
But there's nothing that says what the other 30% could be.
Oh, okay.
Yeah, so that's what's weird. Yeah.
That's a different reading than,
Yeah,
per se.
yeah, but I mean, and that's just practicing. Yeah, I mean, we could have 70% equity in
In
like
real estate.
30%, real estate,
Yeah.
or emerging market debt or something crazy.
Interesting, yeah, because
Yeah.
that's a little different than my
Yeah,
basis.
I mean, and that's exactly what it says. It just says that the portfolio cannot have more than 70% equity.
Right, so, but presumably our reference portfolio is designed to somewhat reference back to the statute, however we determine that it should be interpreted, fair?
I feel like it's matching with the spirit of
Right.
what that would be, rather than necessarily what it
Than
exactly.
what it actually is.
We're kind of interpreting what they meant.
Right.
Right.
Okay. So within that, then, I mean, this is just kind of mine, right? So that's kind of the two-step, right? Then the next is we're going out to asset classes, right? But to a degree, this is just for purposes of AIP and SIOP. I feel like those ought to then be comparisons of what's that incremental step from there, right? I just bring this back up to the private equity thing. So in that regard, I do think traditionally, you do private equity because the idea is that essentially you're paying lower valuation models and illiquidity and things like that. And you can argue about what the number is, but presumably a 30%, 35% premium, right, is a reasonable kind of number, right? Actually, it'd be a little bit more of a premium going that way versus a discount, right? Anyone in valuation classes taught to discount back for liquidity and other factors, right? So in that regard, I mean, I think we're going from a public benchmark, then keeping it kind of what's the next incremental thing. I think the way we're doing it for that next incremental step is still better for purposes of the AIP and SIOP, right? So I'm not,
I think
for
that-
purposes of the AIP, SIOP, like a lot of the stuff we were talking about, I think that's a step too far on the change, right? I mean, if we're
You're
going
saying
from,
don't include, just stop at policy for those documents?
but that's what I don't know, how many layers down do those documents actually go?
Well, I was under the impression that there would not be another document. And if there wasn't gonna be another document that said, here's this framework we adopt, and then parse that into the SIOP, if there's not gonna be that other document, I think the full policy, this whole framework discussion needs to be in the document. But that's two different ways to handle it.
Yeah,
Let's have a policy framework document that we approve, and then take parts of it and put it in the AIP and the SIOP. Or put it all in the SIOP.
And I mean, the way that I envision it is we would put it all in the SIOP. And I think to your point about like you're going from a all public to why do you make the decision to go into private, right? You do it because ultimately you feel like that illiquidity is gonna give you a premium over the public, right?
Right.
Yeah. So I think you.
So my feeling, and I know we have the language is a little goofy, but in my mind, all right, that's your SIOP.
Yes.
Right, then the AIP might go that third level down of, right, because now we're into our implementation for this year, right? I know that's not, I know we kind of have that issue with the sort of muddling of the AIP and SIOP in the legislation, so maybe it doesn't work.
Yeah, half of each is in each.
Right.
Yeah, I mean, it's like there's not a clear delineation between the two.
Yeah.
I mean, some of it's gonna be, we've gotta, quite frankly, we gotta get, that's the next phase of production.
Yeah.
Right, and that may present its own unique challenges that slows this a little bit, but, there's nothing that, on the reporting side, there's nothing that prevents us from seeing it, right? Seeing the effect of all of this, which I would submit is better than the 80 pages of reporting that we give you now.
Yeah.
Right, it's a better way of looking at it than the 80 pages of reporting that we give you now on a quarterly basis. I think there's nothing that prevents you from going ahead and seeing how it's going to work, and at the same time trying to put all of that into words, basically, so, I mean, I haven't taken a stab at it so I don't necessarily know exactly how much. I feel like this is gonna be tear down, rebuild, not, and we're gonna have to if we're gonna incorporate this, we need to come at it from a little bit different perspective than we have previously, while making sure that we have all the component parts of what's required to be in there too. I mean, there's just certain things that are required by the statute to be in both the SIOP and the AIP, and there's not really sometimes there's not a clear delineation as to which one's which.
Can I ask a question, just to make sure I'm following the kind of so imagine there's a methodology document. Is the question you're asking, does that go in the SIOP and AIP, or is it a standalone document that is referred to? Is that kind of the question?
Yeah, to a degree, I mean, I'm trying to recall kind of how the AIP and the AIP has the assumption, I get the two kind of confused because they're kind of muddled in my head.
And ours are muddled in statute too.
You know, in terms of report, right, like one kind of contains, here's what we're working on through the year and implementation and that, right, which presumably that's the AIP, but I don't know that that's in fact the case, but,
It's what it should be, right?
what it should be, whereas the SIOP is really kind of that first high-level reporting. So my point is, I don't think at that highest level, switching the benchmark question to something that's more versus what are we using in here once a quarter as we go, right? I mean, those are two distinctly different questions in my mind, right? Like what type of report I'm looking at. And I felt like the way you asked the question, it was kind of mixing those two a little bit.
Yeah, I think that and maybe the best way to phrase it is, you know, we don't necessarily, and it may be that there's a better, like, having a kind of a separate methodology document is better, and then we just refer to it in the SIOP. I don't, or it's an appendix or whatever. I honestly have not attacked that piece yet, but I'm thinking, but what I'm saying is however it needs to be incorporated in whatever document it needs to be incorporated, or however it needs to be incorporated, do we have consensus on the things that, what we presented today regarding to the benchmarks on the policy box is the next piece that we need.
Are those the right benchmarks?
Are those the right
Is that what
benchmarks?
you're
Yeah,
asking?
for the basically for the 5 asset classes that we're talking about, that would comprise that and the, I guess, the portable alpha hedge fund benchmark too. You know, do we have, basically what we've seen, do we have consensus? And then.
Can we put the 5 back up there? Just to go-
There is another.
You going back to, I think, page. Slide 7 on there.
So that's the reference, no, that's the policy portfolio, policy benchmark.
Right.
But even the implementation benchmark, we don't plan to change that often. So I would even think that would be more an investment policy in the COP as opposed to in the annual plan.
Yeah, the availability of what's available and how it's benchmarked, yes. Yeah, that would be in the, I would see that as in the SIOP. That's not an annual.
And then how we.
Because that's how it's reflected
How we
now.
answer each of the 3 questions is a major policy as well. So, I mean, it kind of sounds like to me that this overall framework really is a COP issue. And we want to modify it from year to year, or maybe that's in the AIP.
Well, yeah, well, and we have a statutory obligation with the SIOP to either change it or reaffirm it every year anyway. So, I mean, you have to revisit it every year regardless, and obviously you have to revisit the annual investment plan because it's annual every year as well, but, you know, I'm probably gonna have to come, like, I mean, ultimately, you know, me and Jeff and whoever's putting this, we're gonna have to come at it a couple of different ways and just try to figure out what's the best. And that's not to say that that's the way that we'll end up.
Yeah, so my reaction on that, I mean, I get moving from multiple benchmarks to a single benchmark, because that makes it, that to a degree solves the tracking and the investability, makes that real simple to understand and follow. And, you know, the ag is easy to invest in, the leveraged loan index is easy to invest in, you know, the global equity is easy, even the NCREIF, you know, you can get exposure there pretty quickly. I don't like using the private equity one there. I mean, I still like the idea of public with some sort of spread for that purposes, because that is a structure you could create.
How?
Leverage. I mean, right, I mean, to a degree, I mean, that's what you're talking about, right? I mean, the typical private equity firm is a double B credit against a investment grade credit if, you know, you're using the S&P or Russell, right? And you put a leverage component on it and you've got pretty much what private equity does.
Yeah, and Frank and I had a lot of conversation about this, and the way we ultimately kind of settle into is you have to decide, what do you want your benchmark to be? You want it to be an opportunity cost benchmark, and that's your public plus.
Yeah.
Or an opportunity set benchmark, where you guys say, we're gonna have private equity. And I mean, I guess the question, my kind of retort to that would be, is that how you would like us to build the portfolio?
Well,
You know what I mean?
so I'm thinking, all right, so this is something that's going in a policy document, a SIOP, generally speaking, right? That should be relatively not fiddled with a lot.
Right. Yeah.
Right, that's
Yeah.
out there for public consumption. It's not that the other question isn't important, it is important, right? But to me, that's something we'll look at in here, right? Whereas this, I think, is kind of more what's going into like SIOP or AIP at that high level from a policy standpoint, right? And I think, given that we're working from statute, right, in 2 asset class out to, you know, 5, right, then I think making sure it's investable, because I think that helps answer that high-level policy question of, all right, complication, staffing, budget, right? How's it doing?
I just don't know if I understand, yeah, I mean, I don't know it's definitely not practically investable at the plan level. Because we can't have leverage at the plan, we can't have express leverage at the plan level. I mean, we can't borrow and then buy, basically. I mean, we can have leverage, you know, synthetic instruments, but we can't. So that's the thing that I don't know if there's a practicality to it, you know, that if we say public plus a spread, because, I mean, I agree with you, it's basically just a levered public, private equity is a levered public return, right? It'd be great to be able to just replicate that and take out a significant amount of cost and complexity. I just don't know if we can, at the end of the day, legally.
Let's go short those negative yielding.
Well, I mean, to answer your question, I mean, to a degree, the way you get there with private equity, you're putting it in an LP.
Sure, yeah,
right?
we're just hiding it somewhere else, right?
Right.
Yeah, I mean, but we can't, the thing with the LP structure though is we can't lose more than we put in.
Right.
That's the difference, right? We're only exposed up to the amount that we have invested, which theoretically, if we did it some other way, then we're creating a obligation for the state, which is unconstitutional. And I don't wanna go to unconstitutional jail.
I get a little bit of discomfort though, if the expectation is we're gonna go out and get private equity. And we're gonna benchmark it against something that's not private equity. You know, that's the mismatch. I mean, they all have flaws, right? And you gotta decide which flaw are you most comfortable retaining, and which flaw are you know, least comfortable retaining. And, you know, to me, public plus, as you think about those boxes going across the framework, to me, since you are guaranteed 300 basis points over, the answer for how much private equity is always gonna be more. You know, for the commission's decision, the asset allocation decision, if you're stacking 300 basis points over, right? If the commission is responsible, you know, for the performance of the policy benchmark versus the reference portfolio, logically, you would, you know, always, if that is how that's gonna work, then you're always gonna have an appetite for more, and not gonna take the risk of what is the asset class actually doing for you.
No, other than the fact that, I mean, the purpose of the SIOP is to set your risk limit, right? I mean, if we put a whatever 10% weight on it, that is the cap. And to your point, yeah, are you gonna run it right up to the limit? Yeah, absolutely, you're gonna run it up to the limit, right? Because it's your higher returning asset class in that 5 policy mix, right? You're gonna run right up to your limits and you're gonna stop, right? But it's at least a statement to the public of why do
yeah,
this.
I get that, yeah.
Right? And so part of it is, I mean, your SIOP is your statement to across the street and to the rest of the public about where those broad risk limits are.
Yeah,
I think it's more aspirational.
Yeah,
to
well,
me.
I think that it's just that practically even though that's where your risk limits are, practically you're gonna get whatever you get though, right? I mean, you're still exposed to the universe of it regardless of whether or not regardless of your expectation, right? I mean, that's I think there's nothing that prohibits us from saying in a policy statement that we expect that it will obviously, we're doing it because we expect it to earn a premium above public, right? And we feel like that we should be capturing the universe, the return of the opportunity set. I mean, you can say it both ways in a policy statement and then capture both ideas at the same time. And then, I mean, because at the end of the day, that's what you're trying to do. By moving to this benchmark, we want to demonstrate that we're capturing both because
I recommend the policy benchmarks, and to simplify it down to my level of thinking, if you do public plus, you're doing apples to orange plus 300. If you're using Burgess, you're doing apples to apples. That's just the way I see it.
I agree.
Wake up.
But I think I understand and I think your concern is very valid. I mean, to a certain extent, in the policy statement, there's a degree of justification as to why you're using it, especially in a asset class that is more expensive to access, right? That you're doing it because you expect to get an outsized return over public.
Right,
Whereas
and there's a risk factor.
Yeah, and that
right,
doesn't.
That's very clearly communicated that
Yeah.
way.
And that doesn't necessarily, the universe benchmark doesn't provide that same level of comfort by just looking at it, because it doesn't necessarily indicate that there's a premium above public. It just means that you're getting if that's the only thing that you're saying in your policy statement. I think we can get there with indicating both in the broader policy statement, I think.
Well, there may be two steps, because the benchmark, yes, absolutely can clearly represent or tell us why we have selected private equity, why we have a reference portfolio that doesn't have private equity, but why we put it in our policy portfolio. The benchmark, public plus 300 basis points, could tell us that. But if we choose the other benchmark, still, there seems to be another decision point again, is why we put private debt and private equity into our policy. And there, it could be described. I mean, and it should be described one way or the other.
Yeah.
Why we have selected those two and real estate, why those three asset classes we have added to our reference portfolio. I mean, those answers need to be in our COP, absolutely.
Yeah, and I think over longer periods, and a lot of this is also measuring things over the appropriate period of time too, right? I mean, because the wild swings that you see in the volatility around the public plus 300 with the lag it's the lag effect, right? But I feel comfortable that there's a way to use the Burgess private equity benchmark, but in the policy documents, describe the use of it in a way that justifies why we're doing it. But, and just let me take a crack at it, and I think we can get there, so, in the policy documents. Because we should expect, if we don't expect the universe to earn a premium, then there ain't no reason to do it, right?
Correct.
Right, so I think, at the end of the day.
There's either a return reason for doing things, or there's a correlation risk reason for doing things, right?
And this is not diversifying from a risk perspective.
Correct.
I mean, this is.
Equity's equity.
Equity's equity, right? So it's not diversifying from a risk perspective, so it better be diversifying from an enhanced return perspective, because you're getting the same or more risk than you're getting in the 70% equity that you have on the public side in your reference portfolio, right? So I think that's the description needs to be, we feel like it's going to earn more, and we also feel like that we should earn as much as our portfolio should be as good as everybody else's. That's the short way of saying it, but it needs to be described more eloquently than that. But I think there's a way to hit both, to justify the use of it, but also say why we're benchmarking it against a opportunity set versus just a spread.
Okay, so Bill Hancock has proposed that we have consensus on these benchmarks. Are we ready to vote?
I don't think you need, we haven't voted on anything up until this point, so I would, Mr. Chairman, I would say, I think we've got the right level of direction, and then, because that gives everybody the opportunity to preserve their, further. I don't think we need to, I feel like I have sufficient direction as to how this needs to go.
The ball's in his court, he's gotta bring us something now, right?
Right?
Okay.
Yeah, I mean, I need to make sure that I'm incorporating all your concerns and that we're trying to address all of them and that we get to the right spot. But I think we've, but with the kind of thing, with the caveat on the private equity, I think there's a degree of comfort on everything. I feel like that there's a degree of comfort, or I have appropriate direction on the other things. I didn't mean to cut you off, Mr. Chairman, sorry.
We look forward to reviewing your first draft.
Second and third.
More than likely, yes.
Firing drafts off on a weekly basis.
I'm just preparing you.
Only fire one bullet, Bill, that's it, that's all I get, out of it, so, yeah.
Okay, well, let's move on to the strategic calendar.
Mike,
Okay.
that's page 156, if you want to get there swiftly.
Hopefully, everyone has had an opportunity to review in the interest of time, I'm going to try to be very brief, I'm going to try to be very brief and swift through this. I think the reason that I think it's good for us to have some agreement and on a strategic calendar is that the goal is, I would suggest that it will, especially the meeting, the way that the meeting schedule as proposed, it aligns that meeting schedule more, it maximizes the availability of quarterly performance data. I think it helps us, having the strategic calendar helps us provide clarity for annual topics, non-annual topics. It gives us visibility into the future and make sure that we are covering these big strategic items on a regular rather than ad hoc basis. And I think most importantly, it will aid in instilling a longer-term focus on investment performance and, quite frankly, on asset allocation decisions as well. So I can run through the individual meetings, but we would propose that the meeting date for September be on the second Thursday, spend a lot of time on second Thursday in September. We spend a lot of time on fiscal and the year-end performance with a longer-term focus in mind. That I'm proposing that for every meeting that we have an asset class deep dive, that would be a very deep look into the portfolio, down to where we see, potential performance, outperformance, underperformance, even at the manager level. And that we would have one big asset class from the 5 asset class portfolio that we would hit at every single meeting. And so that the goal would be that you would get all the way around the portfolio in the course of 1 year. I think also doing this, there would be an education piece to each one of these so that as we bring on new commissioners over the course of the year, they'll be able to really see and understand what we do and how we do it. Obviously, we've got to have the budget approved. A regular order of business would be the AIP progress review. As I alluded to earlier, a strategic investment topic from, Makita, Alborn, one of our managers, at each meeting. We would have our delegated investment report as usual, and then the reviews of myself and my discussion of Jeff's review, or the current CIO's review at the, at that.
You wake up with a bird?
You look like he was,
I'm attuned to these.
Andrew's up, he's gonna pay me $5 for saying that. Every 4 years, we have to select our retiree representative, and we have to select committees per policy every 2 years. December, a lot of the same, but that would be, I would propose that we get a actuarial update, and we would propose that moving the November meeting to December, so that there's the same period of time in between meetings. That we would get an well, I would propose that we get an actuarial update from the actuaries on a annual basis. I would submit private equity, do the private equity deep dive.
Can I ask about actuarial?
Yes, sir.
So they do it as of July 1 every year. So, I mean, I guess my question is the new one out
The valuation,
by December?
usually I think the valuation, usually the valuation's up by December, right? Yeah, they should be able to speak to the valuation, I believe,
Okay,
from
the
the
most
previous
current
fiscal
one,
year, the
yeah,
most
for
current
the-
one.
that-
Yeah, and that's why.
Done that year.
Yeah,
Okay.
that's why I picked December.
Good.
Should be public, yeah.
We would also, go ahead, yes, sir, Ms. Hancock?
Is that for this coming December?
Well, this will be kind of on an ongoing basis. This meeting is scheduled for November for this year. This is the,
Okay.
yeah, so we're not, I wasn't suggesting that we change. I mean, we can pick up the change beginning in the new year, calendar year, but not, right. I'm not necessarily suggesting that we change November to December this time. SIOP review, that's a statutory requirement. There is a requirement in the statute that the commission provide Jeff and I direction on the AIP that you would like to see. Current progress review, strategic investment topic, quarterly performance review. And then I would, every 4 years, we have a fiduciary audit. Usually that report's ready by December. So we could have a presentation from Fund Center, whoever it happens to be at that point. As far as like the March Commission meeting, we would suggest February, move that to the first Thursday in March. We would be able to review the capital market expectations. We've also introduced the concept of reviewing the target portfolio, because I think that sort of dovetails right in with the AIP. So what, kind of over the shorter term, what portfolio are we trying to aspire to, given the policy portfolio and where we are based on kind of more shorter term views, which I think dovetails nicely into the introduction of the AIP. Private credit would be the asset class deep dive at that point. And then you see other topics that we hit on a regular meeting by meeting basis. April, I would suggest that be the third Thursday. The reason that we need to have a meeting in Thursday is there's a statutory, meeting in April, there's a statutory requirement that we adopt an AIP by May 1st every year. That doesn't necessarily mean that we have to radically change it every year, but we at least have to adopt one by May 1st pursuant to statute. I would suggest that that this meeting can be more primarily for the purpose of the AIP approval, but we can have some more strategic discussion. I think having a regularly scheduled macro presentation and discussion would be either, we can tap some of our strategic partners for that regard, or, we would have plenty of resources for that, as well as a strategic investment topic discussion. Real assets would be the deep dive. And then non-annual items, this would be, we would have review our infrastructure business plan every 3 years, strategic plan every 5 years, and fiduciary training every 2 years. And Thursday in June, first Thursday in June. The quarterly performance review, asset class deep dive would be bonds, progress review. That would also be the annual time for the commissioner self-evaluation, the evaluation of our general investment consultant. I won't say current, Frank. I just think it'd be a good time just to have a regularly scheduled legislative update. We will have some non-annual items like the chair and vice chair selection every 2 years, And then I would suggest that June would be the every 5 years big ALM study and asset allocation review every 5 years. So stretch that out to every 5 years. Obviously, if we're going to get capital market expectations every year, we can see whether or not that those cause us to raise any red flags. But I think the big tear down move to every 5 years to help with that longer term focus. Finally, other considerations, are there other strategic items that the commissioners would like to see? The chairman brought up one to me offline, which is having a ERM presentation on at least an annual basis. So I will add that to one of the meeting dates and include that. Obviously, we're gonna have ad hoc discussions. There's gonna be times when we have investments that don't fit within the delegation policy that we're gonna need to bring. Commissioners can also set ad hoc topics that they would like to see, for the next or upcoming meetings at a meeting. And we'll, still have regular reports from committees, chairs, myself, those types of things. But those, I didn't necessarily see those as strategic, those are just more regularly scheduled, so.
What I'm thinking about is, and I feel like we got a mini one today from Makita, but that was through a special education thing, is a formal economic update.
Yeah. I was thinking, that would be a part of regularly scheduled, like a macroeconomic presentation and discussion every April.
Okay,
Yeah, so that's,
all right, I missed that, thank you.
that's right. And we have a tremendous amount of resources that we can draw on to get those, and that doesn't mean that we necessarily just have to have one. For that one person presented that, we could have, dueling, we can make that interesting, is what I'm saying. Not that it wouldn't be interesting, but we can make it interesting. And that's, and that's my presentation on that. One of the things that I think that this also will help with is this will give us a degree of visibility into what's coming up at the staff level, which will also help us ensure that we're providing materials to you all well enough in advance so that you have ample opportunity to review them. We tried to be a little bit more disciplined about that at this meeting, where that's always a work in progress, but if we have visibility into the future, that gives us the ability to prepare a little bit more ahead of time. And we're gonna institute our own internal timelines from a staff perspective on things that need to be done and like gates that we need to hit before the meeting. So ultimately, this kind of expands out into a timeline on a yearly basis for us. So, and last but not least, this is a Funston recommendation, so. So we can,
Okay, further discussion about the strategic calendar. And there will be a vote.
yeah, there's just a motion to
There's
adopt.
a
this.
motion to adopt that we can vote on it after any further question.
And I'll put this in a form that is more readily, put it in a place that's readily available and put it in a form where it's just more user-friendly than just the presentation, so it'll look more like a real calendar.
So moved.
Second.
All right, Mike, will you read the motion?
Yes, sir. That the commission adopts a strategic calendar as proposed and presented at pages 158 to 162 in the red number document, and authorize the staff to finalize the calendar by making any technical revisions, formatting, edits consistent with the action taken by the commission.
So moved.
Second.
Okay, it's been moved and seconded. All in favor, say aye.
Aye.
All opposed, say no. All right, thank you.
That's it for open session, Mr. Chairman.
That's it for open session. May I have a motion to move into executive session?
So moved.
And, Mr. Chairman, if I may, the grounds for that would be to discuss investment matters pursuant to code sections 91680 and through 20, personnel matters pursuant to the Freedom of Information Act, and receive advice from legal counsel, also as authorized by the Freedom of Information Act. Which is,
Thank you.
Okay, we're in executive. Moving into executive.
This meeting is no longer being recorded.
Give me 1 minute, I'll be right back.
Okay, thank you.
Are we standing? We are.
oh, well, I actually like to stand.
It was to encourage.
Reflects eagerness.
Yeah, right.
Okay, we have completed the executive session, and now we're entering the open session. And our discussion of TA Realty executive session led to the motion, which I'll ask Mike to read.
Mr. Chairman, the motion will be to authorize an additional commitment of up to $300 million to TA Realty, SCLP, authorize the CEO or its designee to negotiate and execute any necessary documents to implement the investment as approved by the commission upon documented approval for legal sufficiency by RSIC Legal, and upon expiration of the 3 business day review period as approved by the commission previously, or as it may be extended. And authorize the CEO and or the CIO or the designees to thereafter authorize the custodian of funds to transfer such funds as are necessary to meet the retirement system trust funds obligations with respect to the investment.
So moved. Second.
Further discussion? Hearing none, all in favor say aye.
Aye.
All opposed say no. Motion carries. I ask for a motion to adjourn.
So moved.
So moved.
All in favor say aye.
Aye.
All opposed say no. Motion carries. We are adjourned.
All right.